the best piece of advice you would give to someone young who wants to make a difference, actually, in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The market tends to lead the Fed, and I think you're seeing validation of that now.
The thing which would really cause me concern is a significant fear of unemployment.
If the unemployment rate's going up, you can count on the inflation rate going down, and I think that's the trade they're going to make as they approach the end of the year.
My guess is they'll wind up being content with stopping higher than they stopped last time.
With the economy that's generally speaking slowing, the start of the rate cutting cycle, regardless of jobs, is here.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Maybe last week was a good week to take off after all. I mean, what actually happened? Welcome back. Good morning. This is Bloomberg Surveillance. Today, this week, John Farrow is off. Anne-Marie Hordern and Danny Berger and myself all holding down the fort in the month of vacations. And we'll be getting to that in just one moment. But, you know, Danny, I was thinking about this. Last week, what actually happened? Was this a matter of some fundamental rejiggering, or was this an issue of just no liquidity, or possibly the worst liquidity going back to the peak of the pandemic at a time where you had huge leverage unwinds?
I think that's so important. I was talking to a trader last week who said he was trying to look at options, and it basically looked like an emerging market, that the bid and the ask spread was so massive. And that gets to the point of people saying, can you really trust that the VIX actually went to 65? How do you actually calculate a measure like this when liquidity was so bad? But the fear, Lisa, is it could be all of those things. All of those things could be true, that it was bad liquidity, and there's been a paradigm shift in this market, and we're going to swing up and down as we try to find the new trend.
We're going to have to rehash the toxic brew of potential items that are coming to the fore. I am wondering, though, Danny, if that means that it will continue.
It very well could, but I guess the good news, Lisa, is bonds are doing what they're supposed to do during it, that you can have these big swings in equity markets and you can see bond portfolios gain. The question is, and we're talking with Michael Schowell about this, are we prepared for that? Or did we all change our portfolios assuming that bond stock correlation had reversed forever?
So the first week that I was not here on vacation this summer, President Biden decided not to run again. He dropped out of the race. The second week, we had the biggest vol spike going back to the height of the pandemic. We had a couple of auctions and a host of market volatility that a lot of people have been waiting for. On the political front, Anne-Marie, how much are we looking at a really fundamentally changed landscape where Trump is on the back foot and Harris is riding high?
It's a brand new election. We've seen a paradigm shift, and the last few weeks feel like news that would happen in a decade, as well as you think about the fact that after the attempted assassination on Trump's life, the RNC, it was almost a foregone conclusion. And this is what Michael Sherrill was talking about earlier, and that was the Trump trade, almost a foregone conclusion that he would win, and markets are starting to price that in. Now, markets are taking a look at a very different setup, and actually a serious race with Kamala Harris now in some swing states beating the former president, Donald Trump.
You know, I don't understand why the Fed suddenly has taken on such preeminence in this particular presidential debate, this presidential election. We've heard from now not only Donald Trump, but also J.D. Vance about how he thinks there should be more political interference in the Federal Reserve. Who is this catering to, Anne-Marie?
Yeah, he was doubling down on what Trump said. Trump last week said that he feels like he has a better gut instinct on where interest rates should go and that he should have a say. It goes back to that April report from the Wall Street Journal that said the Trump campaign was looking at ways the president could have more say. But Paul Donovan of UBS said this harkens back to a retro era of the Nixon administration, and the markets don't believe it. They view it as rhetoric, because if they did believe it, they would really start to react to it.
I also think the question of who is this for is really interesting, and I can't help but wonder if this goes back to what Terry Haynes says, that the Republican Party wants to be seen as the party of resistance, and that means challenging a lot of institutions. And I mean, what bigger sort of staid financial institutions is there by the Fed? So maybe it's this kind of narrative that these institutions are doing you wrong and Trump is going to come in and change things and fight for the everyday man. Of course, in practice, it doesn't quite look like that and could be worse for the everyday man.
Well, and meanwhile, when we talk about resistance, he'll be catering to that message on X tonight with Elon Musk, Donald Trump. Meanwhile, we do have a massive week coming up, Danny. We do have a PPI, CPI, we've got Home Depot, we've got Walmart earnings, we've got retail sales more broadly. A real question here of how much volatility could hinge on the backs of some of these metrics.
I also think you were spot on in saying that the Fed response to it might be equally as interesting to the data itself, because so far the Fed has been saying it's still inflation. Bowman, Collins, all of them saying we are not there yet. We want to see inflation cool more. And it's a market that's already moved on from inflation, that already cares more about the other side of the dual mandate. So what happens if CPI does come in even just a tad higher? Do markets need to recalibrate? Are they prepared for that potential reality?
Make Fed speak great again. Right now we're seeing in markets a bit of clawing back after last week's drama that ended pretty much with a flat market on the week for both the S&P and the NASDAQ. Today you're seeing up about 0.2% on S&P futures. The dollar really front and focus after the unwind of a lot of carry trades tied to the yen. Dollar weakness expected on the heels of some of those Fed rate cuts. Euro strength, not because of the euro, but because of the dollar. 109.29, up about 0.1%. 10-year yields higher, clawing back again. Some of the declines that we saw in yield, down about 20 basis points last week. 3.95 currently. And crude, after a 4.5% rally last week, up about 8% at $77.65, traded in the NYMEX. Coming up this hour, we've got Tony DeSpirito of BlackRock as investors prepare for a busy week of data. Scott Bessent of Key Square Group on the outlook for a possible second Trump administration. We can ask him about the Fed. And Eric Resnick, don't miss this, of KSL Capital Partners on the state of the consumer and the travel sector. He oversees all sorts of resorts, has investments in hotels, the Icon Pass, et cetera. And we're going to be having a week looking into what some of the travel sector is seeing with the health of the consumer as people wrap up their summer vacations. We begin with our top story. U.S. stocks looking to build momentum heading into a busy week of data for the investors and the Fed. Tony DeSpirito of BlackRock writing this: market focus moved from rate-cutting exuberance to recessionary fears. We have been saying for some time that we expect volatility to rise and the market to broaden. Tony joins us now. And Tony, great to have you. Thank you for being in studio. I believe this is the first time you've been in this studio. You're talking about how you expect volatility to rise and the market to broaden out. How much are those two ideas compatible?
Well, I think that's what we've seen happen, actually, since the beginning of July, both a broadening of the market, right? If you look at the equal weight S&P 500, it's outperformed, value stocks have outperformed, et cetera. So that's been the broadening. And then we've obviously had the rising volatility. And that's something we've been calling for a while now, because both of the phenomenons we've seen, extremely concentrated Mag 7 performance combined with very low volatility, is absolutely abnormal.
Which to me is compelling, especially because you wrote this, our approach more technical than fundamental. How much is what we're seeing purely technical, overcrowded trades, unwinding of carry trades versus fundamental weakness?
Yeah, so I think it's very much technical. Think about how we went into this. If you looked at June 30th, if you looked at a cap-weighted measure of momentum, it was in the 5th percentile over the last 12 months. That's extreme positioning. So we went into this with extreme positioning. And then a few things moved the market dramatically, right? I think part of it was the lack of liquidity that we see normally during a summer. You have the unwind of the yen carry trade. And the market has moved from, oh, this is great, the CPI is slowing, the Fed's gonna cut, buy small cap value stocks, to, oh no, the Fed's behind the curve, buy min-vol stocks and sell everything else. And that just doesn't make any sense. And when you look at the underlying fundamentals, yes, the economy's slowing, but in a good way, right? Through labor participation growing as opposed to layoffs. It's, if you look at the Fed Now measure, the Atlanta Fed, that looks pretty healthy. Earnings season's really good. So I think the underlying fundamentals are still very strong, and this is mostly technical.
So where does that leave us now? If we had this technical froth come off the top, you had credit spreads finally widen, you had the dollar yen did what it do, you had Japanese stocks selling off the most since 1987, and then a rally in the back half of the week. Right. So where do we stand in terms of stretched and frothy technicals?
Yeah, so I wouldn't be surprised if the volatility continues for a while, even through the fall, right? September and October tend to be volatile months. And then after that, I think as you get into the October earnings season and you see, oh, everything's still okay, I think that's when we'll see all this settle down.
Well, I know you say don't time the market, but in some way, should I see every time stocks drop like they did, do I need to lick my lips and say time to buy up?
Yeah, I do think when you get a decline of 10% or more, which happens, is not uncommon. I'd say once every other year you get that kind of event. That's typically been a buying opportunity. So yeah, I do lick my lips when I see that, and I do get excited.
You say in your note that you want to take this more discerning view of the market. This potentially can be a stock picker's dream, what we're seeing right now. What industries are you looking at?
Yeah, so when I think about stock picking, I think about skill and volatility, right? The more volatility, the more you can apply your skill and make money. And so I think there are a lot of interesting sectors right now. If you look historically at Fed rate cuts, one thing that always works, or has always worked, I should say, has been quality and low beta. And right now I see a lot of low beta stocks. They're actually pretty attractively priced. Healthcare, staples, even utilities.
Okay, so we have the Fed rate cut, but then after that, it's going to be a U.S. election. Do you position differently for politics?
I don't think you can. I think you have to look, and yes, there are certain sectors that may be at risk if one person wins or the other person wins the presidency. But for the most part, I think what you want to do is avoid that kind of risk and just go straight up the middle.
When you start to look at some of these opportunities that benefit from rate cuts, how concerned are you that we've overpriced some of the potential depth of rate cuts, certainly this year and even next year?
Well, I think one of the nice things that the Fed has set up here is by raising rates to over 5%, you really create a lot of room to cut, right? And so I think the Fed now has a lot of cushion, and so we could get a number of cuts over time, and that's kind of what the market's expecting.
How much, though, does this really hinge on CPI? And this is a reason why we heard from Ela Richardson that this is one of the most important moments going forward, simply because on one hand, you've got growth concerns, on the other hand, you have the Fed's inflation mandate. And if inflation doesn't cooperate, it really ties their hands with how much they can use that lever of cutting rates. How much, if we got a hotter than expected inflation read, not just this time, but also over the next couple of months, how much would that shift your view?
Yeah, so I think that would definitely give the Fed pause. But remember, the Fed's going to look at both the economic data and the inflation data. And if you go back to 2007, right before the global financial crisis, in 2008, inflation was still really high. If you remember, oil peaked at 140 in June of 2008, and then the Fed was cutting despite that. Why? Because they were worried about the economy. So if the Fed got really worried about the economy, they'd cut even with inflation, and they'd look at it as a lagging indicator, not a leading indicator. I don't think we're there.
Tony DeSpirito, thank you so much for being with us today. Don't be a stranger of BlackRock joining us here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The CEOs of Britain's biggest companies received record pay last year, but a slower pace of growth saw the gap with the U.S. widen. Median pay for FTSE 100 CEOs edged up 2%, just over £400 million, but that's well short of the 21% increase they saw a year earlier. Median pay for CEOs of S&P 500 companies, meanwhile, were up 12.5%, according to data provider ISS Corporate. Oil prices are extending their first weekly gain since July, climbing back above $80 a barrel. OPEC is trimming forecasts for global demand this year, but it still remains above industry consensus. This coming as traders continue to monitor Iran's expected response to last month's assassination of a Hamas leader in Tehran. Meanwhile, OPEC is still expected to raise crude production in the fourth quarter by roughly 545,000 barrels a day. And Disney announcing a new Villains theme land is coming to the Magic Kingdom Park in Orlando. The exact opening date and details remain in the Disney vault, with the company only releasing this concept art. This is part of the $60 billion investment into the parks the company had previously announced. On surveillance last week, Disney CFO said that weaker demand for the parks is expected over the next few quarters due to economic constraints on the consumer. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Did you guys read that story about people visiting theme parks more frequently, in part because the wealthier consumer is going overseas and the consumer with less income is keeping their money?
Disney CFO said that they actually expect the parks to do better next year because the high-end consumer is jetting off to Europe and they want them to come back.
They want to come back to Mickey Mouse and Donald Duck. Up next, politics facing the Fed. That is coming up next. This is Bloomberg Surveillance.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rates.
World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Heading into another week of likely volatility, that is what we're hearing from everybody who has come on this show. Right now, we're seeing just mild gains on the S&P, although building on that, up almost 0.25%. 10-year yields just marginally higher, and crude still with a lift on geopolitical concerns. Under surveillance this morning, politics facing the Fed. Here is the latest. Vice presidential nominee J.D. Vance backing Donald Trump's call to let presidents influence monetary policy. Trump has continued to push the idea after a news conference at Mar-a-Lago last week. Vice President Kamala Harris has maintained that Fed policy should be independent of politics. Joining us now is someone who really has inside knowledge and is a wonderful macro investor who has a ton of respect. Key Square Group founder and CEO Scott Besson. Scott, thank you so much for being with us. I want to start with that, the idea of the Federal Reserve and its independence. What do you make of this actually being such a hot topic on the presidential campaign trail?
Well, I think it's kind of a canard that the financial press has blown up. You know, all presidents want a say, and I think they have a right. You know, Donald Trump is going to make his opinions known. I think Senator Warren, before the Fed decision, recently, the day before, said they should cut. The day after, she came out and said they made a big mistake not cutting, and I think that's within her right. And I'm not sure what all this is, or what this allegedly means that people are saying Donald Trump thinks he should be in the room. If he wins, he will get to choose a new Fed chair. The Treasury Secretary meets on behalf of the administration with the Fed chair every week, so the administration's opinion is known. And I've written and talked quite a lot about, I already think politics are in the Fed because I think Janet Yellen's taken over the Fed.
Scott, though, when it comes to what Trump is saying, and J.D. Vance really doubled down on this yesterday on CNN, he said that fundamentally it should be a political decision, agree or disagree. Doesn't that thwart the independence of this institution? And haven't we seen that in the past under Nixon, and it didn't exactly work?
Well, I think, again, I think it's all up to the Fed chair. And, again, the president, he or she, always has input. We saw from Joe Biden, State of the Union. I'm expecting a Fed cut. We saw a week later in Philadelphia, I'm expecting a Fed cut. Then the inflation numbers got hot. Oh, I'm expecting a Fed cut, but just a little later. So, again, presidents, make their wishes known. And, I do want to comment, I think this Wall Street Journal piece that referenced a 10-page document, I would challenge them to produce that 10-page document. I do not believe that document exists.
Okay, well, I just want to dig into something that you said. You think that Janet Yellen has already taken over the Fed. I wonder how much this is really in reference to the fact that the Treasury Department has been selling a disproportionate amount of T-bills. Some people say it's been offsetting some of the quantitative tightening, as well as what we're seeing with respect to rate hikes over the past few years. How much do you believe that the Fed is way more political than people expect, and that is something that you can trade around even?
Well, look, what I've been able to trade around, and, we'll go back. Your question on Yellen Treasury, highly political. Unfortunately, Secretary Yellen has thrust herself into the middle of a campaign in a very inappropriate way. She gave a highly politicized speech in Arizona a couple of months ago. She was standing on stage with the governor of Pennsylvania campaigning for Kamala Harris, who is not even, her president, 2 weeks ago. So it is politicized. The quarterly refunding schedule was changed. For the first time ever, they gave forward guidance. So how do you know what the conditions are going to be? Why do you have a Treasury borrowing committee if you are going to give forward guidance? So to come back to the Fed, look, the Fed, I think they try to keep politics out of it. We all have biases. 93% of the people at the Fed are registered Democrats. But I think in general that they are doing what they can with what they've got. Your question in terms of how do I trade around that? I've actually had very good luck this year trading against the Fed. That anytime they publish their so-called dot plot, the SEP, the Summary of Economic Projections, they've been wrong. So for all year, they had 3 rate cuts. I didn't think there'd be 3 rate cuts. Then at the June meeting, they published that there would only be 1 rate cut, and we traded against that, and that's proving to be wrong because now the market's pricing in 3, maybe 3 jumbo rate cuts.
Scott, if we could look into some policy that has to do with the Fed and the Treasury. It's well known that you're one of these individuals that talks to the former president, potentially could be part of his future team if there's Trump 2.0. He gave an interview with Business Week and talked about a weaker dollar. How would he see that through?
Look, I think that's a preference, not a goal. That I think he believes, and again, I think about it more in terms of, are other currencies undervalued? Is there some kind of a manipulation, i.e. the Bank of Japan running, excuse me, ultra loose monetary policy for 12 years and doing a gigantic depreciation of the yen where it goes to, a 50-year undervaluation. is there something that the Chinese are doing with their trade policy that is causing an artificially weak the RMB, versus a strong dollar. So, I think remedying, these undervaluations as opposed to remedying, a strong dollar is a better way to think about it.
Well, probably no one would like that more than Japan. I mean, they have not liked the weakness that they've seen in their currency. So do you foresee something like a Plaza Accord? Is that what we should be looking at? Should there be a Trump administration with these, again, specific currencies, renminbi, yen, to right-size some of the inequilibrium that you're talking about?
What was your question? Should there be a Mar-a-Lago Accord?
Mar-a-Lago Accord. Sure, we can call it that. Why not?
Well, I think that's what it would be called. That I could see, something, or a policy, specifically targeted at the different countries that are in violation, maybe rather than a global, thing like Plaza Move was. If you go back and look, I've studied this a lot. What's different this time is if you go back and look at the history of the Plaza Accord, the Louvre Accord, the Soviet Union was never mentioned because their economy was so small. So you had, a security threat and then an economic threat. Now with China, I think we should view China as both a security threat and an economic threat, and it is going to require a lot more finesse with them just because they are such a big part of the global economy. So you don't want to upset the apple cart, but you want to be prudent in terms of supply chains and national security.
How do you then view a weak dollar, though, if Trump is saying that he's going to put up the walls for the tariffs, 10% ring around the United States, 60% of imports coming from China, as well as what he says, mass deportations? Right.
So I think we've discussed this before. President Trump speaks in a different way than many politicians. He speaks like a New York City real estate developer, and I think that is the opening the gambit. I've used the term, it is a maximalist negotiating position. I think a lot of the analysis around this in terms of inflation has been quite sloppy. At our firm, we try to have better models. And our models show that A, those are maximalist positions, and B, everything that I've seen, in sell-side research and other firms and commentators, assumes that there is a jump on day one, which will not happen. I have spoken to the president, spoken to his team, and I think everyone is on board with a kind of forward guidance or a phased-in tariff. So, here's President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. And at the end of the day, I think that Donald Trump views tariffs as a way not to, as an end to free trade. Like, if you bring down your tariffs, we will bring down ours. Recall that at the G7 meeting when he was president, he left Ottawa to go to North Korea, and on the way out the door, he said to all the leaders, I'll get rid of my tariffs if you get rid of yours. So I think he views like the tariffs as, kind of negotiating, almost like a sanctions policy.
Well, Scott Besson of Key Square Group, will you be living in Connecticut or will you be living in Washington, D.C. next year? We will find out. Scott Besson, you'll have to come back, of Key Square Group. We appreciate it. Coming up next, Eric Resnick of KSL Capital Partners on the Travel Outlook. We're going to be talking all about what trends are existing in the consumer after years of record travel amounts. Are they tired or are they continuing on their adventures? This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back. This is Bloomberg Surveillance. After a week of tumult and unwind in terms of leveraged trades, we are seeing some stability in markets pretty much across the board, looking sort of similar to where they were before I left for my week-long vacation that I will never get teased about. However, we will be talking all about vacation and where people are going and what that means for the state of the consumer in just a moment. Under surveillance this morning, Republican Vice Presidential candidate J.D. Vance floating a $5,000 federal child tax credit. This would more than double the current level, and Vice President Kamala Harris joining former President Donald Trump's calls to end taxes on tipped income. Just quickly, Anne-Marie, how much can we really give credence to anything anyone is saying at this point? Is this basically, as we were just hearing, red meat being sort of, dropped in bits to try to cater to certain groups of voters?
Well, there's that. And there's also the fact that Terry Haynes, and he brings up rightly so, that none of this really matters until we know the makeup of Congress, because you need Congress to enact some of these policies that are talking about. I thought it was obviously so interesting that both Trump in June, Kamala Harris over the weekend, they're in Nevada talking to an industry where there's lots of workers that make money on tips, talking about this idea. But actually, when you look into some of the data behind it, and we have some analysis on this, from Budget Lab, they said a meaningful share of tip workers represent less than 4% of all employment in the United States. They already pay no federal income tax because they earn less than the federal minimums. So what this potentially could do, though, and what a lot of people talked about when Trump brought this up in June, is that some lawyers, hedge fund managers, could potentially make fees, taxes, and actually then they can usurp around this.
Yeah, I mean, this sort of goes to the question of what are we actually hearing in terms of policy. Meanwhile, Bank of America CEO Brian Moynihan telling CBS that the bank no longer sees a recession on the horizon for the U.S. economy. Moynihan going on to say, consumer spending is slowing, but it's heading to normal, adding that the team expects the Fed to cut in September and December, not talking about that 50 basis point rate cut that a lot of people are talking about in markets. Danny, to me, this is the divergence that we're hearing and seeing from every guest who has come on this show. You take a look at markets, they're freaked out, they're whipsawed, they're also over-leveraged, have been overconfident, and basically over-leveraged this idea of a soft landing. In the real economy, slowing, but not slow, everything is chugging along, and that is what you're hearing from pretty much economists and investors across the board.
It's the pendulum, right? To we're going to have a recession to, jobless claims surprised by 7,000 people, therefore we're not going to have a recession. My favorite thing of what Moynihan said was, we have to be careful that we don't try to get it so perfect that it actually puts us in a recession. It's this idea that the Fed can be preemptive. He's saying they don't need to be reactionary, that things aren't falling off a cliff, but they have the luxury of being preemptive, so they should cut. It's this idea, again, that recessions are not an event. It is a process. And again, he doesn't think we're in a recession, but that doesn't mean we can't get there. So maybe the Fed is behind the curve and they should be moving.
I love that. Embrace the mess. Life is messy. It's okay. You don't have to be so perfect. A busy week of data ahead with PPI and CPI on deck. Investors also waiting to see results from Home Depot and Walmart. We're also talking a lot about some of the retailers catering to vacations. We saw that last week with earnings coming out a bit softer. You do see certain numbers coming down in discretionary spending, definitely coming off the boil. Eric Resnick, co-founder of KSL Capital Partners, is focusing on the consumer and the outlook for travel and joins us now. And Eric, first, so great to have you on the show. Thank you for being here.
Thank you.
And your firm oversees tons of some of the most popular names that people go and visit, whether it is, the icon passes of ski lovers or whether it is the Marriotts and the Ritz-Carltons and the Four Seasons that people attend. Do you think that there is too much pessimism right now about this sort of pace of spending, particularly on the discretionary front?
I think there's too much reactionary thoughts happening based upon short-term data. When you look long-term, and I'm really here to thank you for being a customer of the Icon Pass. I'm on a swing. I'm on a swing thanking each one of our customers personally, and this is my morning to thank you.
Okay, you can call him up if you've got an Icon Pass. And
That's right. I'm here. Yeah, feel free to call me. No problem at all.
Okay.
But the long-term trends for travel are really positive. People don't realize how actually resilient travel is, even in the face of economic volatility. You know, we make what you were just saying. We have to embrace the mess. Life's messy, as you were saying, and the reality is, in that mess, what do you want to do? You want to escape. You want to be able to have special memories and experiences with your friends and family. And so we see the long-term trends being favorable. We do see the same type of softening of trends. It's still fine, still good, but it's not as robust growth in some of the segments that we invest in that we saw over the last 2 years coming out of COVID.
I guess that there's a bigger question. We were talking about this with Neela Richardson of ADP earlier this morning, and she was talking about how the pace of job creation is actually still above 2019. You can point to similar types of trends in travel. People still spending more on travel now than, say, 2019. Is this the new normal where we can expect more spending at an accelerated pace, or are we going back to the old normal where people actually had to work?
Well, the have to work thing is an interesting one. I do think that the trend of remote work, of people having leisure trips, we were just talking about this on the break, combining purposes of trips, I think that's all positive for travel. Because when you want to combine things, what do you tend to do? You're combining something that's vacation-oriented or recreation-oriented with what you're doing at work. So we see, you know, skier visits, for example, are growing more rapidly midweek than they are on the weekends. Well, that's a better experience for the guests. It's better for everybody. I'm not sure about people saying they're working from home on Friday, if we know that skier visits are up disproportionately on Fridays. But be that as it may, we're pro that. So I think the new normal is, you know, we're all on all the time. We want to combine purposes and be more efficient with what we do. So I think in the end, that's probably good. It probably creates more balance for people, and for us, it creates more opportunity for them to vacation and recreate and do those things that we certainly like to invest behind.
I just have the vision of someone like with their laptop on a ski lift, blurring out the background, saying, "Don't pay attention to the wind swinging back and forth," and what you're saying.
Right.
But so you're talking about this, the trend and the spend and how much that is normalizing. What about just what people expect when they go to a luxury hotel? Has something fundamentally changed after the COVID era of not being able to get out, and they now want something different with their hotel experience that they didn't before?
I think that's fair. I think they want to have more than just your basic hotel experience. During COVID, we saw an expectation that it's okay to reduce services at hotels, right? We couldn't staff, we didn't want to have physical contact, so we eliminated some of those things. That type of expectation has now come back, but the guest wants more than that. They want to be able to go on a trip. Business travel is different, but for leisure travel, they want to be able to go on a trip and have more meaning. So for some, that meaning is wellness-oriented, and they want to do, you know, it could be as simple as a spa treatment. It could be something that's more holistic in terms of mental health, or could be something physical, right? So I think the consumer, they just want more out of everything that they do. They want to feel that that's value.
What does that mean for the Airbnbs of the world? Where do they fit into that? Because they're not exactly providing that kind of service.
They're not. I mean, look, Airbnb and others in that business, they are trying to wrap around experiences. And you see experiences is a watchword that you hear on whether it's earnings calls or you see in consumer conversations. But I think Airbnb has that challenge, which is it's great if you're in a city because I don't need the restaurant necessarily or retail experience to be in my hotel in New York City. It's the city is my canvas, is my resort. But you know, if you're in a resort destination, you want those amenities. That, you know, on the one hand, Airbnb offers wonderful value because you're getting more space and you can cook your own meals and, you know, congregate easily at your home. But it doesn't have the amenities, and I think they're trying to address that. And I think they'll have some success doing that, which is good for the consumer and I think good for the business.
Where are travelers going right now?
I mean, you're seeing a bit of a dichotomy in that Europe is hot, Japan is hot, currency is part of that. Part of that is you took international away, right? What happens when you take something away from someone? You know, I mean, if you're a parent of teenagers, you realize this. You take something away, they want it more. And COVID took international travel, especially, away from us. And with currency being, or the U.S. dollar being strong and foreign currencies being a bit weaker, combined with coming out of COVID, you're seeing a lot of the luxury consumer want to go to Europe, want to go to Japan, and so that's creating, kind of a normal or not yet a normalization of travel patterns. I expect that we're seeing in some segments, but the consumers, the affordable, the more budget-conscious consumer is cutting back a bit more right now. The luxury consumer is going more abroad. I witnessed, Lisa going abroad last week, but the not to out you there,
yeah,
but
it's okay. Everyone's doing it this morning, so why not?
First day back from vacation. It's what we all do.
Okay.
So you're seeing a real bifurcation in where consumers are going.
A bit. If you look at like select service spending for hotels, those trends are a bit softer than the higher end. In the last year, you saw RevPAR for more luxury travel to be positive still, 3-4%, while select service RevPAR is down. And I think that's indicative of that. But again, it's not dramatic, right? These are evolutionary, not revolutionary shifts in consumer behavior that we're seeing. Normal volatility, not abnormal volatility.
One thing that you have is a really good lens on what the balance sheet equation really looks like right now, especially at a time where we are talking about increasing oil prices maybe on the margins. You see increase in commodity prices. You talk about how suddenly workers and that sort of consumer experience is much more important. How much are margins getting squeezed?
If you look over the last 4 years, or I guess now 5 years since pre-COVID, 2019, our margins are up. We've been able to move price more than our costs, even though costs are up a lot, right? I mean, the average worker wages in our sector are up probably 20% in the last 4 years, which is a lot, but price is up 20 to 25%. So that equation still works. I think if you have less distinctive properties or less distinctive experiences, you don't have that same pricing power, and margins are being hit more. And that's a challenge. I think right now, if you look at urban hotels, their margins are under a lot of pressure still. It's getting better as the business traveler has been coming back, but it's something to watch out for.
Are you seeing hotels trying to spend to be able to deliver that? And then what does that mean for margins? If in order to get the larger margins, you need to have this all-around experience, but to get the all-around experience, you have to build a lot of capabilities.
Like everything, it's a paradox in life. I mean, you have to be able to do two things at once, right? And so I think hotels that have the ability to spend on the consumer experience to create more differentiation and therefore, justify a higher price to that consumer because they're providing that value, they're doing that. I think you see that, but other hotels that don't have that ability, I think they're seeing more challenges. We're seeing that. We've got some wonderful resorts in Italy, in St. Bart's, that they put tremendous emphasis on the consumer and guest experience, investing in spa, programming, wellness, off-site activities, picking you up from the airport with a great car, those types of things at the luxury end, right? They're seeing prices that are exceptionally high and still able to push prices. At the other end, if you're a more nondescript hotel, I mean, it's tougher today because the consumer is being more discerning in how they spend their money.
So you talk about bleisure, which is a difficult word for me to get my head around. Bleisure, it's fun to say, actually, and how increasingly businesses are mixing business with leisure. What's your life like? I mean, do you basically just go around and just experience the different experiences that your properties have? And you just basically go there and you say, I need a spa treatment to really understand the value that you're providing.
Yeah, that massage wasn't quite as good as it should have been. I need to do another one.
Exactly.
Yeah, it's a lot of that.
Yeah.
It's not as interesting as you would like to believe. Business trips do tend to be to probably some more leisure-oriented destinations than most, so it's fortunate in that regard. I spend a lot of time talking to the leaders of our businesses. We have about 25 business leaders across our portfolio. I spend a lot of time meeting with investors, meeting with other owners or constituents in the travel and leisure business. It's a large and growing sector, right? It's the third largest sector of the global economy. It's 10% of global GDP, 10% of global employment. But you have to stay connected to the ground of what actually is happening. Not quite the massage and the spa, although I try to partake in that once in a while. But I try to get a sense of what the consumer is looking for. And so I spend a lot of time on the road. And a lot of time trying to understand consumer trends, investor trends, and the mindset of our management teams and the challenges that they deal with day to day.
And on the ski slope on a Friday to see how many people are working from the slopes. Eric Resnick of KSL Capital Partners, thank you so much for being with us. Truly a pleasure having you here.
No, thank you. Thank you all.
Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackett. Yahira.
Hi, Lisa. Foreign investors pulled a record amount of money out of China last quarter as they continue to sour on the world's second largest economy. Outflows reached $15 billion in the last quarter, just the second time the country has recorded negative numbers, according to China state data. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data began. Scotiabank has agreed to buy a minority stake in KeyCorp for about $2.8 billion. The move is part of an effort by the bank to increase its footprint across North America. Scotiabank will acquire just under 15% of the Cleveland-based bank, with shares purchased at an 11% premium to their volume-weighted average price. KeyCorp has about 1,000 U.S. branches and oversees about $187 billion in assets. KeyCorp was among the hardest hit regional banks in last year's crisis after the Fed hiked interest rates. And a mix of economic uncertainty and a weak period for earnings forecasts is likely to cap stock market gains. That's according to Morgan Stanley's Mike Wilson. He expects the S&P 500 to trade in a range of 5,000 to 5,400 as he sees macro data flashing no clear signals over the short term. On top of that, Wilson says we're likely to see analyst profit downgrades outnumber upgrades in line with seasonal weakness. His counterparts at JP Morgan also said they expect a mixed outlook for stocks through the summer months. Get ready. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. We're going to take a poll about whether people think it should be bleisure or lisness in terms of blending business and leisure. Up next, not that, testing the soft landing thesis.
Up to 5 cuts by the end of the year with only 3 meetings to go. That seemed, massively excessive. The market massively overreacted and it completely priced the Fed wrong.
That's coming up next. This is Bloomberg Surveillance.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Let's check out what's going on with the bond market, because last week it was rather volatile. This week we're seeing a bit of a retracement back to lower levels than where we were before the vol freakout. What are we going to call that?
I don't know. Vol-mageddon 2.0, no, it doesn't work.
It doesn't
We
work.
need something that's akin to bleisure. I don't know how we're going to make it work.
Bleisure, we'll try to name that and coin that. If you have ideas, please write in. Right now you're seeing for the 2-year yield 4.05%, with people expecting a likelihood of 100 basis points of Federal Reserve rate cuts this year. Under surveillance this morning, testing the soft landing thesis.
Up to 5 cuts by the end of the year with only 3 meetings to go. That seemed, massively excessive. The market massively overreacted and it completely priced the Fed wrong. But it's obviously going to take a bit of time for this to be priced out. We're looking for the CPI data this week, Jackson Hole next week, and we may need to see some more data, especially the next labor market report, for that to actually be removed from the market pricing.
Here's the latest. This week's major data points, PPI, CPI, and retail sales, are set to test the idea of a, quote, soft landing for the U.S. economy. U.S. growth fears are beginning to unwind, but traders are still considering the potential for an economic slowdown. Bloomberg Economics expecting soft inflation prints, but for retail sales to show consumers pulling back. Deborah Cunningham of Federated Hermes joins us now. Deborah, I want to just get your sense of how much of what we're seeing in the bond market was a reaction to true fundamental economic concerns versus a similar kind of overweighting of the soft landing thesis and just sort of an unwind of crowded positions.
I think it was much more of the latter, Lisa. It was definitely an overreaction. We saw something similar at the beginning of the year, 2024, when we came into the year, and for most of the fourth quarter, we were pricing in, I think, almost 7 cuts, 6.9 cuts at one point. And a similar reaction, I believe, has occurred over the course of the last several weeks. Now, thankfully, by the mid part of last week, the market had maybe regained a little bit of its sensibility. Some Fed speak had come into the picture, sort of, talking back the market from that overreaction, and we saw some retracement occur. Not enough from my perspective, but better than it was at the beginning of the week and the end of the week before that.
What you're saying is actually really important, especially given what we heard from Michelle Bowman, really pushing back against the market and saying, you guys, inflation is still very much a concern for us, and don't get ahead of yourselves. How much do you think that the market is still, and this is what you're basically implying, that basically maybe sell on the margins some of the treasuries that have gotten bid up most, just simply because there is more to retrace in terms of yields going higher?
Absolutely. That's our mantra at this point. If we can take some gains, if gains are available, which they should be and are in most instances, it's probably a good time to do that. Although maintaining duration and maintaining weighted average maturities is also a goal. So maybe we've been looking at it sort of in the context of a barbell, where some of the longer dated paper provides more gains, whereas some of the shorter dated paper maintains some of what the current Fed stance is, which we think is appropriate. So, maybe maintain with somewhat shorter paper than you would maybe like to do at this red hot moment in time. But with an overpriced market, we just don't think that's the right strategy to buy longer at this point.
And Deborah, as you say, in the meantime, you're getting these big swings on pieces of data like ISM services, on jobless claims, things you usually wouldn't associate such big swings with. What does that tell you about what this week is about to look like when we get tier one data in the form of PPI, CPI, and retail sales?
We are very much ready for volatility. Volatility seems to be the name of the game. It seems to be what the market wants to do right now. It wants to react to every small piece of data, overreact on what I'd call maybe the upside from a standpoint of let's call it the downside, from a standpoint of, potential growth slowdown, hard landing versus soft landing, potential recession versus hard landing, and less reaction on, sort of the normalcy that I think the Fed is trying to gain. But nonetheless, I think what that means is volatility. So there's opportunity in volatility, and that's essentially what we're looking to find, with every day's trade.
Part of that normalcy, which the Fed is trying to talk about, is concentrating on inflation. This is something that Lisa had pointed out as well. So if we do get a hotter CPI this week, Deborah, does the market have an ability to concentrate on it again or care about it again? Or has that just too far gone and we're going to try to bully the Fed in trying to care about labor markets?
Bullying the Fed never works. So hopefully that, is not the tact of the market. I think it needs to be constant reinforcement with not just a CPI print, but maybe some additional, sort of less important, but nonetheless additional data that is confirmation of, what we're seeing from an inflationary perspective. So I do believe the market is capable of it, but not in a single print of a single number.
Deborah, what does that mean for where you see yields here? Because that is something something that could potentially send yields much higher than they are at the moment, if that is a concern, if inflation still needs to be a worry?
I think that's where we need to see the market go. I think what has happened from a bond market perspective is overdone. And we saw some of that retracement last week, but I think there's more of it to come.
Just to put a bow on this, Deborah, we were talking about how a lot of people are relieved to see bonds acting as a haven once again during periods of volatility. Are you saying not so fast?
We are saying not so fast. Maybe, absolutely the Fed's next move will be to decrease rates. And maybe instead of that being 1 or 2, and not starting till maybe November or December, maybe it's moved up a little bit. It's more like September. But it's certainly not intermeeting moves. It's certainly not 50 basis point moves. And as such, I think that's why there is, some retracement that continues to need to be done. But nonetheless, I still think, yields over 4% and maintenance of those for a period of time is of good value.
How many rate cuts right now do you expect for the remainder of this year, given the fact that you think 100 basis points is probably overdone, and it sounds like you don't think it's very likely that the Fed will go 50 basis points in one meeting?
I don't. So we're looking really at 50 basis points for the rest of the year. Outside chance of 75, but unlikely that even that will occur, because I think the Fed does not want to signal that they're wrong and that there's a bit of a panic and that they need to move faster than anticipated, unless they truly believe inflation is under control and the market is slowing in a way, the economy is slowing in a way that I think at this point is not expected.
Deborah Cunningham of Federated Hermes, thank you so much for being with us. As always, really interesting to me, this idea, Danny, that pretty much across the board, whether it's stocks or bonds, people are saying that it's more technical than fundamental.
Yeah, and what does that mean if you have a long-term vision of where these markets should go? You almost have to put that to the side, because you can be really punished in the meantime. Just hearing what Deborah's saying, this idea that yields could be higher, that we could be over 4%. It's a bad time for that, because the whole market just moved long treasuries. JP Morgan's survey of clients just moved to the most long treasuries since April. It is this pendulum swing that keeps going back and forth, and it feels like we keep, to the Wilson analogy, running on both sides of the boat and getting sort of crashed out every time we move.
And it raises a question about what liquidity means, because when you actually look at the trading volumes, they're at incredible amounts. They're at record paces for treasuries, for a whole host of other instruments, and yet the actual moves and the gapping out in bids would suggest a very different type of backdrop. Coming up next hour, Vinu Krishna of Barclays, Daniela Bretthauer of HSBC, Laura Rehm of FS Investments, and Jane Foley of Rabobank with an interesting change to her call regarding euro strength on the heels of some of those Fed cuts. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, I will say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. The top names in global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises.
That might be part of the problem, in that we are being whipped around on every single cyclical data release.
Financial markets aren't as important as they think they are.
In my outlook for equities, it does not figure prominently what the Fed does, one way or the other.
They ought to be, and I think they will, erring on the side of caution if we do get additional negative data.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Heading into a big week, made even bigger after last week's turmoil. This is going to be a fantastic week of CPI and PPI data as well as earnings. We have Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. I am playing vacation tag with Jonathan Farrow. His week is this week. He is off for the week, but he will be coming back after that. And Danny, to me, this is really such an interesting moment where people are wondering how much of some of the turmoil of last week really was driven by fundamental weakness.
And you get the feeling that this week will serve as a reality check on that. Was that micro crisis justified once we get all this data pouring in? Because markets, end of the week, as we've been saying, basically unchanged. But the volatility itself is important because volatility tends to cluster. And are we in a moment where each piece of data we're going to get this week, which there's a lot, we're going to see big swings up or down?
And this has been a massive week and a massive couple of months politically. We are about 2.5 months, less than that, until the U.S. presidential election, at a time where some people are saying that was what was behind last week's turmoil. Part of it anyway, this idea that we had gone from Trump as the given sort of expected next president to a completely different race, Emery.
Well, this is what Michael Shale was saying at the start of the show. He said this is on the margin, something that he did see, this unwinding in the Trump trade, just on the margins. It really was a perfect storm in terms of so many different issues hitting the market at once, probably the biggest for sure being also the growth scare and the data points, which is why this week is so interesting. So we're going to get that CPI report, and everyone is waiting for the Fed to lean in on some of this deterioration we're seeing in the labor market. And then what do we have over the weekend? Michelle Bowman coming out and saying actually inflation is still a top concern and we're not at the 2% target.
And Deborah Cunningham saying part of this is really just trying to push back on some of the expectations that got ahead of their skis. We also get Home Depot Depot tomorrow. We get Walmart on Thursday at a time where people actually looking at the consumer, or Eric Resnick saying that actually people are still spending. They might be paring back on the margins, but this is sort of a normalization and not something that's more fundamentally weak. Why are people hooked into CPI as really actually even more important than some of the consumer data that we get?
I think it's so interesting because it is about how the Fed will react this week. If you get CPI even a tad hotter, expect more people to sound like Michelle Bowman, who we know is probably the most hawkish Fed member. So you can kind of brush that off, saying, of course, she's going to be talking about inflation. But if CPI does get in hotter, do you get maybe some of the more dovish side talking about this? Do you get their concentration swaying from the labor market, swaying from Home Depot, whatever they'd say, and say, sorry, folks, we don't have the luxury of cutting because inflation is still a problem.
Especially if people are trying to get ahead of the weakness that a lot of people are seeing more broadly in markets. We did see a pretty big, wild roller coaster last week that seems to have right-sized itself with some mild gains this morning, up about 0.25% on the S&P. A lot of this driven by what we saw in the currency markets, given the unwind of the Japanese carry trade. Dollar weakness, widely expected. We're going to be speaking coming up with Jane Foley of Rabobank about that and why that is likely to continue. 109.27 on the euro. 10-year yields, this is fascinating to me. How much is Deborah Cunningham kind of sounding the alarm and saying people still have not fully unwound some of their hopium about some Fed rate cuts and the ability of the Fed to keep cutting, and crude prices continuing higher after last week's rally, after a host of escalations in the Middle East, among others. Coming up this hour, Vinu Krishna of Barclays, as traders brace for a big week of U.S. data. Laura Rame of FS Investments on why she expects a slowdown, but not a recession, another person in that camp. And Jane Foley of Rabobank on her outlook for the dollar if Fed cuts next month. This is really what a lot of people are honing in on. We begin with the big issue. Stocks looking for direction after a volatile week, with traders pausing ahead of the data. The S&P 500 finishing the week roughly flat, rallying back after Monday's plunge. Wall Street now betting that Wednesday's CPI report will add fuel to the September rate cut fire. If the FOMC moves forward with a cut, Vinu Krishna of Barclays sees a clear bias for defensive outperformance based on historical trends. Vinu joins us now. Vinu, thank you so much for being with us. Before we get into how you expect the market to respond, how do you understand what we just experienced in the market last week?
I think a huge element of it for the last few weeks, in fact, has been technical. And we feel that that probably has some more room to run. But in general, this velocity of the moves we are seeing, the magnitude of moves we are seeing, and the kind of underlying shock factor behind those moves all suggest that this is more technical in nature. But that said, I think on the fundamental side, there are a few data points which have changed. We had a weak claims number that reversed recently. And then you had a weak CPI number, but then you had a very weak PMI number. So I think there are some mixed signals which are coming out, which clearly has brought to the center the fact that perhaps the downside risk to U.S. economic growth is a little higher than what we thought. So in our own view, for example, we had assigned a risk for recession to 10 to 15%. Now it's probably 20, 25%, right? But still, our view at the end of the day is that the odds of a soft landing are much higher. And the risks have become a little bit more balanced versus accelerating versus a recession kind of environment.
You know, a lot of people are saying this is more technical than fundamental, and yet we've seen how technical can become fundamental.
Sure.
I'm curious what the vulnerability is currently baked in markets, especially if a lot of the leveraged trades haven't been fully unwound yet.
Yeah. No, I think that risk stays in the market because I think depending on which you're looking at, part of the unwinds are still probably left. But if we look at, for example, systematic strategies, things like wall control, like CTAs, our house view is that that's pretty much unwound quite sharply. For example, wall control was at 110% allocation. We believe they've cut to 50% quite sharply. But we are in an environment now where seasonally it's choppier. And typically in second halves, you see bigger drawdowns over history. And now the market is focusing to macro data back again. I know you were talking about CPI recently. And a week ago, if you looked at the S&P forward wall curve, then CPI was not important. In other words, you went away with the feeling that the market is telling you that the Fed is directing us that CPI is under control. What we care about the labor market. Come this week, it's changed quite sharply. Now the wall market is telling you, we do care a lot about CPI, right? And so I think this back and forth is quite dramatic. So if I look at the forward 1 month, for example, where are the problems or what is the market really caring about? It's CPI, it's the ISM number, and the NFP number. So clearly, it is more growth oriented, and the market is really on the edge about whether US economic growth is sustainable and whether we end up with a soft landing or not.
I am really curious in this idea of this feedback loop, kind of to what Lisa was asking about. Does bad equity market performance feed into the economy? And I'm thinking of it specifically in, you hear Cisco over the weekend laying off thousands of people. We know Intel also laying off thousands of people. Is the very fact that investors are more willing to punish equities when they underperform directly feed into the economy? That you can have these companies who are looking for more levers to pull with margins and potentially laying people off. So again, you get a feedback loop of weak equity performance means weakness in the economy.
Well, I partly agree, but I think if you step back, the tech sector specifically, has been going easy on hiring for a while now, right? So after the 22 sell-off in big tech especially, they've been going very easy on hiring, and it's very targeted, mainly on machine learning and AI kind of areas. But I think the question is that the equity market has been posting excellent returns, right? And so you're at a point now where you need to take a breather. And for example, if you look at where the angst is in the market, you saw big tech in July and June rise almost 25%, driven by their valuation multiples going from 29 times to 34 times. That was a red flag, right? Because it's not as if their earnings are suddenly accelerating. If anything, big tech earnings are decelerating, even though they're still at a very, very healthy pace. So I think this is a market where the balance of fundamentals are quite decent, including big tech. But clearly, you want to be very careful about, for example, what multiples you pay for big tech, which has been dragging the market up on a consistent basis, right? So we would be comfortable in the 25 to 28 range. Anything more than that is risky, and correlations increase when big tech corrects. That's what you saw recently.
But when you see the correction like we saw last Monday, is that a time to get into big tech? Is that a time to really double down if you do think these are the growth prospects of the future?
The answer is yes. So our view is that it all depends on the entry point, right? So at 34 multiple, for example, we are uncomfortable. But once you come to the 20s, we are comfortable. The reason is big tech was growing at 60%, then 56%. And now this quarter, by the way, the expectation was 32%. They're delivering close to 40%. So the realized earnings growth are tremendous. At the same time, like I said, they are decelerating, right? The forward, if you look at 4 quarters, the expectation it settles in the 17 to 20% range. Now, that is a deceleration, but still extremely robust. So I think the question is, what happens in the future in terms of in the tech area, with the focus shifting to monetizing AI and things like that, and do these companies deliver these kind of earnings? If they miss on that 70 to 20% number, then I think we have a problem in hand. Because the rest of S&P is doing okay, but the creep is marginal, and the impetus and the ballast is coming from big tech. If there's a problem over there, that is going to spread.
This really raises this dichotomy right now in the markets. We were speaking with Tony DeSpirito of BlackRock, who thinks that we're seeing this broadening out and that actually you're going to see equal weight S&P catch up to the market cap weight S&P 500 that has been dominated by the big tech names. Yep. Sounds like you disagree.
No, we do agree with that, but I think it's going to be incremental. I think the hope for that trade has been there for 9 months now, and it hasn't happened, right? The same people telling you it's going to broaden, and we were on the other camp. We said, learn to live with narrowness, and that's what happened. Now, though, what's changed is big tech outlook is moderating somewhat because of the monetization angle, and rightfully so, and the huge amount of capex they're spending. Suddenly, people are waking up and saying, you're spending $200 billion. Like, what's the return? What I see today is hardly anything, right? That's important. But the broadening is the rest of S&P. For the last 2 quarters, we have seen a positive operating leverage in S&P, which means earnings growth accelerating faster than sales growth. And that has been partly aided by the rest of S&P as well, even though it's marginal. So I think incrementally, if you look at what numbers are telling you, you see big tech decelerating, but you have rest of the S&P accelerating. Where we are skeptical is the pace of accelerating, which the market consensus is telling you it's going to be 15-ish%, probably will be less than that, because half of S&P is still facing margin pressures as the extraordinary pricing power they exercise and they benefited with peak profitability is now rolling over as demand is moderating.
Vinu Krishna, thank you so much for being with us of Barclays. I love all the sanitized way of saying that consumers just won't take it anymore and are saying, absolutely not. If you're going to hike prices by 10%, we're not going to buy. I mean, that's basically what we've been seeing now.
Unless you're going to a luxury resort somewhere.
The bifurcation
then,
depends who you are.
Depends if you're with Bleisure or, what was the other one? Bleisure or Lizness?
Lizness?
Yeah.
Lizness.
Well, let's get you into advanced stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Israel is strengthening its infrastructure defense as it faces heightened risk of attacks from Iran or its proxies in the Middle East. It comes as Iran reiterates its pledge to seek revenge for the killing of a top Hamas official in Tehran. Meanwhile, Hamas called on mediators to come up with an implementation plan for a ceasefire based on earlier talks rather than begin a new round of negotiations with Israel. The U.S., Egypt, and Qatar have scheduled new talks this week, which Israel has said it will send a delegation to. Germany's economic outlook is facing the bleak prospect of hardly any growth this year. GDP is expected to rise 0.1% in 2024, down from a prior prediction, according to the medium forecast in a monthly Bloomberg survey. Data has shown the country's industrial woes are continuing to hold back growth, causing Europe's biggest economy to unexpectedly shrink in the 3 months through June. And former President Donald Trump plans to sit for an interview tonight on X with its owner, Elon Musk. The billionaire is promising an unscripted discussion with no limits on subject matter. Musk often butted heads with Trump when he was in the White House, but he endorsed the former president after the attempt on his life last month. Elon Musk's interview with the former president is set for 8 p.m. tonight. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Danny, evidently the House of Lords messaged in to weigh in on Bleisure versus Lizness.
Correct. A Lord has messaged me saying that it is leisure, not leisure, so it needs to be leisure.
This is why we don't have lords in the United States.
Well, there we go.
This is the very reason.
Anyway, let's move on. Up next, the morning calls, plus Daniela Bredauer of HSBC ahead of a big week for retail results. That's coming up next. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Is it over yet? That is the key question this week after last week's tumult. We had a roller coaster of volatility, of a spike up in yields with respect to credit, a spike down in yields with respect to treasuries. And what you're seeing today in markets is calm. Evidently, for now, it might be subsiding. Right now, we're seeing S&P futures up about 0.25% at 53.83. Euro really gaining pretty much across the board last week. Right now, 109.23. A real question here, and I want to sit on this for a second. Danny, how much currency volatility really was underpinning all of the drama last week?
And maybe that's why today is calm, because Japan's on a holiday today, so we don't have that trade. The thing that I think is interesting to contemplate, even if currency volatility was the thing that started it, are we in a position now where big cap tech and the Japanese yen are just linked, even if they shouldn't be? I mean, a lot of people said that people are funding their tech trade with the currency, but does it mean we'll get in a position where come NVIDIA earnings, if they're volatile, that you also see a reaction in the yen? Is there some sort of interlink between the two now, just because we did have Monday's event and it showed some sort of strange relationship between the two?
There's also a question about other crowded trades that are getting some fundamental rethinking, and I'm thinking of crude. And Anne-Marie, I know this is your bailiwick in a lot of ways. We're not just seeing increased tensions in the Middle East, which seems like an ever-present kind of drum be in the background, but also a lot of oil producers are actually cutting back their production and saying they're worried about a glut of oil. How much have we seen a really changed landscape in crude?
Yeah, Javier Blas recently wrote about this, trying to maintain that floor for OPEC Plus at $75. This is something that actually they probably would like to see a lot higher, but even $75 is hard to maintain. Most notably, the U.S., even more of a record producer now, 13.4 million barrels a day. At the same time, what did we discuss this morning? Record amount of outflows coming out of China. You see a growth weakness in China, which notably that would be the place that you'd see a driver for more consumption.
Well, time now for the morning calls, looking beyond macro to micro. First up, Piper Sandler upgrading Robinhood to overweight with a price target of $23. The analyst citing the stock's recent pullback as an attractive entry point into a, quote, innovative, fast-growing brokerage platform. Next up, Wolf Research downgraded Qualcomm to peer perform, seeing headwinds as Apple swaps supply chains for its iPhone 18 AI processing modems, expecting Qualcomm to lose market share on all but U.S. phones. And finally, Evercore initiating a tactical outperform trading call on Walmart ahead of Thursday's earnings report. The analyst praising the big box retailer as a, quote, steady ship providing a port in the storm of consumer volatility. Sticking with retail, Daniela Bretthauer of HSBC maintaining her reducing rating on Home Depot, but lowering her price target to $318, citing the pressure of higher interest rates and lingering pandemic effects with do-it-yourself customers stuck on the sidelines. Daniela joins us now. Daniela, thank you so much for being with us. Just at an overview level, where are we in terms of the normalization post-pandemic where everyone went to sort of shore up their homes because they were going to be stuck there for the foreseeable future?
Hi, good morning, everyone. Thanks for having me on the show. Let me begin by sharing you our base case scenario for the U.S. economy, which stands the Fed should start easing in September and the U.S. economy avoids a recession. So that's HSBC base case scenario for the economy. And according to our regression models, currently the market is pricing a 30% chance of a recession, up from 10% of a risk of a recession last week. So with this easing, the U.S. economy would avoid a recession. And we recently increased the number of rate cuts this year to 25 basis points, to a cumulative cut of 75 bips. And with regards to Home Depot, the current price is broadly in line with the stock's value in the last 6 months. It has been a favorite name for income investors that look for dividend yield. We have a 2.5% dividend yield for Home Depot. But, Home Depot has missed Wall Street's revenue estimates 3 times over the last 2 years. And weak consumer spending, higher interest rates, and the economic downturn recently could hinder sales recovery for the home improvement projects and negatively impact Home Depot's growth.
Daniela, we've been talking a lot about the bifurcated consumer, that you're seeing weakness on the low end. Is there any sign in any of these earnings that it is starting to migrate upwards?
So, yeah, thanks. Great question, because over the past few months, we saw more evidence of a tired consumer. Large cap names such as Walmart that operate in a more defensive sector of consumer staples tend to outperform under a risk-off scenario. And Walmart, which reports on Thursday, it's usually perceived as a good proxy to the state of the U.S. consumer.
Daniela, though, it's not just a good proxy for the U.S. consumer. According to on the lower end, according to Walmart's last earnings report, they talked about wealthier consumers trading in, trading down. So is this just says something about the consumer as a whole, or is it about Walmart taking market share from other players?
So the takeaways from the Walmart quarterly results are: one, consumer wallets remain stretched, but they responded well to Walmart's strong value proposition. Second, food inflation continues to moderate. It's down from where it was at the end of last quarter, and it should stay at low single-digit rates for the rest of 2024. And third, the U.S. consumer, even the wealthiest one, is now shopping at Walmart. So they do have reported market share gains among higher-income consumers.
Just quickly, Daniela, is there anything in the earnings or some of the commentary that you've been really focused on that suggests that we're headed into a bout of real consumer spending weakness beyond what people are expecting?
No, I think that it has, as you put it, it has been bifurcated since the beginning of this year. So consumers are spending more on travel and other discretionary purchases rather than complex housing projects or remodelings of their homes. So I think this scenario, until we get, again, a clear picture from the Fed, but even if we do get the cuts this year, it's something that only in 2025, given the new government and the results of the election, then I think that's where we'll get a more defined scenario for the U.S. consumer.
Daniela Bredauer of HSBC, thank you so much for being with us. Appreciate your insights. Really interesting to see sort of the push-pull right now and the dichotomy between the Home Depots of the world still struggling under some of the changes in that industry versus Walmart, which is cashing in on pretty much every trend, Anne-Marie.
Absolutely. And with Home Depot, it's really these big ticket items that you just don't see consumers coming back like they did during the depths of the pandemic when they had flush with cash and really nowhere to go or spend it. And then Walmart, I still can't get over what the CEO said last earnings call. We are starting to see more wealthy consumers come to Walmart and trading in. They're looking for deals as well.
See, this is interesting, an idea that you can have this almost investment play where you say, what actually benefits from higher end consumers coming down? Is it Walmart? Is it a Disney park? Because people aren't going abroad, they're just going to parks instead.
It depends whether they want, Mickey Mouse or Donald Duck, or whether they want, food. Coming up next, Laura Rehm of FS Investments, as well as Jane Foley of Rabobank, as we parse through the debris of last week's volatility and take a look about whether it will continue. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to a week where we gut check the volatility of last week. Markets seem to be calm for now with about 0.25% gain for the S&P 500. Let's whip through the markets and really understand where they are after a week of up and down and then leaving pretty much in the same place that it began. So basically it was okay to take the week off. That is what I am told by everyone. Right now the S&P futures up 0.3%. NASDAQ futures up 0.4%. The Russell 2000, Danny, lagging behind even after all of the hopes and dreams of this broadening out. Russell 2000 still not really seeing those kinds of outsized gains.
And it's such an unfortunate time because how many people did we hear the rotation is finally come? It is finally time to buy Russell 2000, even if it's not about the politics. I mean, you heard that too. Sure, the Trump trade catalyzed it, but if the Fed's going to cut, then it means you can buy Russell 2000. The fear is that the Fed is cutting because the data is starting to deteriorate. And if that's the case, can you really be buying small caps?
What does widening out mean? Does it mean small caps that are more susceptible to rate cuts actually helping them, but also more vulnerable to weakness versus just the rest of the S&P 493 catching up? If you take a look at what's going on in bonds, that really is the underpinning of a lot of what we've seen. A huge expectation for Fed rate cuts after the weaker than expected jobs report and a host of trades being unwound, frankly. Two-year yields have retraced a lot of that, now about 4.04%, although actually down on the day after earlier having been up, still basically range-bound. This has been pretty dramatic. 10-year yields 3.93 and 30-year yields 4.22. I hear that last week auctions were interesting. Make auctions interesting again. Danny, was this something that really triggered some of the gut check about how far some of the rally could go?
Well, it was a feeling of if yields are below 4%, are we really going to add more duration? And if yields are below 4%, do we start caring about the deficit? Because if this is the trajectory, does it mean auctions are going to start looking like 2023? In other words, Lisa, the market saw you were off and said, maybe now is the time to freak out.
Yeah, well, you know, I was looking at it on my phone to try to have bleisure. Meanwhile, in the currency markets, you are experiencing that dollar weakness pretty broadly, and that really is one of the key questions here. Euro gaining 109.23, and coming up, we're going to be speaking with Laura Rame, who has changed her call somewhat as a result not of euro strength, but of dollar weakness, given the expected Fed rate cuts and the Fed reaction function to a lot of the economic data that we have coming down the pike. Under surveillance this morning, Kamala Harris raising more than $12 million in an event attended by top Democratic donors and politicians. This is the latest New York Times Siena College poll, shows Harris with 50% support compared to Donald Trump's 46% in key swing states, Wisconsin, Pennsylvania, and Michigan. Emery, over the weekend, a lot of data, both on the funding point as well as on just voter appetites, giving them a real boost.
Yeah, and I would go back to what Libby Cantrell told us, which is don't really look into the polls until after Labor Day. But if we're going to play this game and look into the polls, I love what the Financial Times put out. Because on the top, it looked like Harris has finally caught up to Trump, especially on the issue of the economy, that actually more voters say they trust her in the economy than Trump. Trump has always been the standout. But then if you look under the hood, really interesting numbers. 42% said they'd be much or somewhat better if Trump won another 4 years in the White House, and just 33% said they'd be better under Harris' presidency. And actually what you saw is that most respondents said Harris needs to distance herself from Joe Biden. This idea of Bidenomics, they're going to be on the trail together this week. I want to know if that actually helps or hurts her.
I think that distinction you draw is so important, of more people saying that Trump will help them personally, better off financially, because people vote in their own self-interest. So the idea that a Harris campaign can take a victory lap after this isn't quite so. It goes back to what Terry Haynes said. She has momentum now, but there are lots of stumbling blocks ahead. And perhaps they need to position themselves and get a coherent message around the economy, be it distancing themselves from Biden, in order to kind of keep that momentum going.
Next week, the DNC, you will be there, and we'll be covering that in terms of how much of a boost that gives and how the messages change tonight at 8 p.m. Eastern. You do also have Elon Musk interviewing Donald Trump, the former president, on X, formerly known as Twitter. We'll start to get a better idea of how the U.S. consumer is faring as Home Depot and Walmart report this week. Home Depot's same-store sales expected to slump for a 7th straight quarter, while Walmart's ability to appeal to all income levels could protect it from consumer weakness. This is the interesting aspect of these two companies, Danny, that on one hand, you have Home Depot struggling with a lot of secular kind of housing-related issues overlaid with the consumer appetite, and Walmart is just basically cashing in on all sides.
It's this thing that every time we look at earnings, we say, is this idiosyncratic? Is it just a Delta problem that their earnings weren't great? Is it just a CVS problem? But maybe that's the point. When you have these individual companies make missteps, the market is less willing to forgive it, because if you don't have that economic growth, you can't kind of paper over some of the issues. So with Walmart, is it the opposite? Are they just doing better because they position themselves well for this moment? Or is this moment, should we have a bigger read of it, that it does suggest that it's not just a lower-end consumer struggling, that maybe it's moving upwards?
Well, yeah, and is Walmart an actual consumer staples company, or is it, you know, an advertising company, or is it a media company, or what else is it doing, given the fact that it's really cashed in on some of its platform and technological edge? Meanwhile, traders are bracing for a big week of data, U.S. PPI and CPI coming on Tuesday and Wednesday, respectively, followed by retail sales and another round of jobless claims on Thursday. This week's inflation data is the next crucial print ahead of a widely anticipated September rate cut. Joining us now ahead of all of that is Laura Rame of FS Investments. Laura, great to see you. Thank you for being with us. I want to start there in terms of what you're expecting to see with respect to economic deterioration to either confirm or really kind of question what we saw in the non-farm payrolls report for July.
I think the way that I'm describing the evolution of the economy right now is an incremental slowdown. And it's hard to remember, the beginning of July feels like a lifetime ago, but everything was maximum optimism, volume 11, like no slowdown from a very strong pace of growth for as far as the eye could see. And I think what we're facing now is a deterioration to something that's more sustainable. I want to be clear, I don't see this as actual weakness, but for markets who've been only given upside surprises for 6 quarters now, it's an uncomfortable surprise. And we're seeing the downside of that hyper concentration that you spoke of off the top.
I like your reference to Spinal Tap and the everything to 11 comment earlier. There's this issue also, though, of just how much room the Fed does have to respond. You believe that they do have the luxury of being able to cut rates because inflation has been coming down, and yet you have been among the people for the past couple of months who've been saying that the upside surprises to inflation might be much more considerable than people expect. How do you pair those two ideas?
This is a tough needle to thread. And to me, the Fed now is very, they're going to cut rates. I think the biggest question is, are they very badly behind the curve? And that's where I would say no, for 3 reasons. One, our economy is just less interest rate sensitive than it has been in the past. So we're going to get a Fed rate cut. The question is, how much juice is that actually going to give us in the near term? I think the second reason for me is that while clearly we're facing a really nice soft patch of inflation today, I think when you look just a little further, several quarters ahead, some of the problems of rent, of services are probably not going to go away. I don't think the Fed has the latitude to just slash rates down 200 basis points over the next 4 quarters like markets want. Again, unless the economy really changes trajectory. And I think the third thing is that they know they have a little bit of time. We've seen real rates correct down. I think that if they really feel like they're seriously behind the curve, they are going to take that chance to cut. But one payroll report, it's just too volatile. I don't think that's enough to really move the needle significantly.
I was going to say, because when they talk about having more time, they often talk about it in the context of this labor market, that yes, hirings have slowed down, but layoffs haven't started. To that, Neil Dutta of Renmax says that they're playing with fire, that hires slow before layoffs, and using layoffs as a crutch is unwise. What do you make of that, Laura?
I think he's really, and this is an important point, because the unemployment rate moves asymmetrically. By that, I mean, it goes down really slowly and it shoots up. And we do have a really, I think, scary history of this asymmetric response in the unemployment rate. But if we're going to be all in on the soft landing, and we don't have to be, I think landings are bumpy, and that's one thing that we're experiencing in markets. We need to watch the unemployment rate like a hawk, and we need to really be, if it gets to 4.5, if it starts to move in 0.2% increments every month, I think that's a situation where the Fed does cut significantly. But this is an important tipping point, and I think you look back to the one case where we didn't have a recession when the Fed cut rates, the mid-1990s, you did see the unemployment rate kind of move up a little bit and then stop. But it's a tricky time. I would agree with that.
Well, where we are right now in the unemployment rate at 4.3% is roughly where the Fed wants to see us at the end of the year. So where do you think the unemployment rate will be at the end of 2024?
I think we're going to be about here, around 4.25. And again, this is the dance of, a lot of companies actually announcing capital expenditures in their earnings calls. We're going to need a lot of investment to put things like AI into practice. This is, I think, where markets got ahead of themselves. It's not just a profit story, it's also a spending story. That's great for the economy, it's great for growth. It's not so great for free cash flow yield. And that's, I think, why we've gotten this real snap back, because you had the problem of concentration. And when we talk about the need for investors to widen, I would absolutely agree with that. It's even beyond traditional markets, because what we're seeing today is, I think, good for the economy and good for productivity growth. But for publicly traded markets, it's a challenge.
Just to sort of finish up, looking ahead to this week, what do you think is going to be the most compelling data point or earnings release that could shape your view going forward?
I think CPI is going to be important. I think retail sales are going to be important. The CPI numbers, markets are really just looking to check the box on the Fed, putting that rate cut into place. I expect it to be another friendly report. We're going to see a lot of volatility. Just the next quarter, brace for that, because Fed policy expectations are going to swing around. I'm still only looking for a 1/4 point cut, but you roll right from that into the elections, where we know the volatility picks up in the 2 months before an election hits.
Laura Rame of FS Investments, thank you so much for being with us. Joining us now, someone with a call on what's going to happen with the euro, Jane Foley of Rabobank. Jane, you actually recently changed your view on the euro to actually increase it, seeing a likelihood of 110 rather than 105 previously versus the dollar, because not euro strength, but dollar weakness. Just pairing this with what we were hearing from Laura, Jane, how much do you see this hinged from U.S. weakness versus just simply rate cuts that might be beyond what people expected?
Well, there's obviously a lot of different stories interlapping into the euro-dollar story. But I think if we go back to the start of the year, we'd always had the view that the dollar would weaken towards the end of the year, because that's when we were anticipating that the Fed would start cutting interest rates. And so we're coming up towards the end of the year right now. And, it is our view that we are likely to see a Fed interest rate cut in September. But, I really must caveat that, because if we go back a week when we had the market anticipating really aggressive Fed interest rate cuts, we were never of the view that that was going to happen. I think what we saw a week ago was a combination of a lot of different factors all coming together, and one part of that was positioning. The market was too positioned in the carry trade, too positioned short the end, too positioned perhaps long in tech stocks, too positioned perhaps in US equities, and I think a retracement happened all at once, which created the chaos that we saw. But our view all along is that, we'll have some moderate Fed interest rate cuts towards the end of the year. We're still of that view.
How much do you think that some of those carry trades have been fully unwound? How much are left?
Well, that question again needs to be put in some sort of perspective. How much should be unwound? I mean, certainly if you were in the carry trade, maybe at the start of last year, you'll probably still be in the money. I mean, certainly if you look at some currencies, maybe MEX against the yen, currency trades like that. I think we have unwound more or less everything that we are going to unwind right now. And the reason for that, particularly when we talk about dollar yen, is because I think the market has to still settle down in terms of the views on the Fed. I think the market was far too excited a week ago in pricing in too many Fed interest rate cuts. The data this week clearly in terms of the US economy is going to be really imperative of giving the market a lot more balance in terms of what is really realistic from the Fed. And at the same time, well, yes, maybe the Bank of Japan can hike interest rates again, but maybe that won't be till the start of next year. So from that point of view, I think a lot of the really extreme positions, and there was a lot of them, have been washed out right now. And I think maybe dollar yen can settle out, maybe still relatively volatile, but nothing like what we've seen. So maybe 145, 147, that sort of trading band until we get more data to really clarify what the fundamentals are suggesting for that currency pair.
Jane, is there some degree where just the carry trade isn't attractive now, that it's linked to low volatility? And if we're entering a summer that's already been volatile, if we're entering a period of politics, and as you mentioned, the uncertainty over the Fed, that even when trades do unwind, they won't be put back on?
Yeah, I mean, you are right there, because one of the reasons that the carry trade has been so popular in FX this year has been because volatility has been, really very low. So if you enter into an environment with higher volatility, high news events, and certainly, the Fed and the US election are really big news events for foreign exchange, yeah, there is the likelihood that those sorts of trades will become certainly, less fashionable. And we're not, I would expect, going to go back to the situation that we were in, maybe about a month ago, with everybody and their dog, short of the yen. I don't think anyone's really anticipating that's going to happen. But, at the same time, it is the nature of foreign exchange that there is going to be some degree of carry trade in there, but just not as popular as we were just a few months ago.
Jane, last time you were on, we talked about the dollar and what it means for this Trump trade, and how sometimes the policies Trump talks about means a stronger dollar, but he's been on the record talking about how he actually wants a weaker dollar. Do you have any idea on how the dollar would trade with a Harris administration?
Well, I think we've already seen some of this coming through. The Trump trade, we all started talking about it hugely, of course, after that debate between Biden and Trump. But now that Biden has stepped back and Harris is there, and Harris is doing better in the polls than Biden was doing, then the market's obviously scratching its head and thinking, well, maybe we were too hasty in pricing in this Trump trade. So, if we assume that Trump would bring in more aggressive tariffs, if we assume that there was more chance of tax cuts under Trump, well, they're inflationary, therefore it's suggestive of less Fed cuts, and therefore it's more dollar positive. We can assume perhaps that Harris would be more friendly in terms of her allies when it came to tariffs, because I think the direction for protectionism is still going to be there, but perhaps less so under Harris than under Trump. But if we assume that there is less reason to panic so much about tariffs, then we've got to assume that maybe the Fed is going to be able to cut interest rates a little bit more, and that's dollar negative. But of course, putting a spanner in the works is the Trump and the Vance dialogue about the president should be able to control interest rate policy. Now, I don't believe that would happen, but if it were, then we're looking at a completely different outlook for the US dollar.
Jane Foley of Rabobank, it has not been a boring August for you. Thank you so much for all of your insights, and talk with you again soon. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. Scotiabank has agreed to buy a minority stake in KeyCorp for about $2.8 billion as part of a focus on increasing the bank's footprint across North America. Scotiabank will acquire just under 15% of the Cleveland-based bank, with shares purchased at an 11% premium to their volume-weighted average price. KeyCorp has about 1,000 U.S. branches and oversees about $187 billion in assets. KeyCorp was among the hardest hit regional banks in last year's crisis after the Fed hiked interest rates. Meanwhile, OPEC trimmed its forecast for global oil demand this year and next as the cartel prepares to decide on planned supply increases next quarter. In its monthly report, OPEC said it could pause or reverse the increase depending on prevailing market conditions. Oil prices have fluctuated in recent weeks as concerns over escalating tensions in the Middle East were offset by signs of weakening economic growth in China and the U.S. And Paris handed over the Olympic baton to Los Angeles in true Hollywood style, having actor Tom Cruise rappel from the roof of the Stade de France into the closing ceremony. LA will host the next edition of the Summer Games in 2028, and already planning is underway, with the city's mayor addressing the big issue, saying they'll encourage remote work and non-standard working hours to prevent traffic chaos during what she's calling a no-car Olympics. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. That was actually really exciting to see Tom Cruise kind of go in and sweep down. And
unbelievable. He's in his 60s. Can you imagine? Just, it's, yeah, he does his own stunts still.
Yeah,
so cool.
I'd say it was cooler when the Queen of England did it in London.
When she swooped out on the
yeah, I mean, it was fake, but it was, you know, still cooler.
Was it? Then it was called
You're just playing into the lords that are watching.
Up next, setting you up for the week ahead, you're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Less than 40 minutes until the opening up bell here in the New York. Here is your trading diary for the day as well as the week ahead. Today at 8 p.m. Eastern, Donald Trump sits down with Elon Musk for a live interview on X, formerly known as Twitter. Tuesday, we'll get U.S. PPI followed by Fed speak from Bostic, plus Home Depot earnings. Wednesday, CPI, don't miss that. Thursday, retail sales, plus another round of jobless claims that are taking on increasing importance, and more Fed speak from Musalem and Harker. We'll also get earnings from Walmart. Rounding out the week on Friday with UMich sentiment survey, plus more Fed speak from Goolsbee. Joining us now is Bloomberg's Michael McKee. Mike, you know, it seems like Fed speak actually matters a whole lot more this week than it has in previous months.
Except.
Oh, come on.
We've already heard a lot from Austin Goolsbee and a little bit from Raphael Bostic, so I don't think we're going to get a whole lot more there. Alberto Musalem from St. Louis hasn't spoken very much at all since he took office at the beginning of the summer, but it may be interesting to hear what he has to say about it. Probably the most interesting aspect of Fed speak recently was actually over the weekend with Mickey Bowman, the Fed governor, saying, even if we get the numbers we're expecting this week, we might not need to cut rates yet. As one analyst this morning put it, there's two things here. There's one is what the numbers say, and two, what the Fed's reaction to those numbers are. And we're going to get the market's reaction to the numbers, but we really need to hear from someone like Jay Powell or John Williams before people have a pretty good idea of what we're going to be seeing in September.
Given what Bowman said, when we look at this week's calendar, do we need to be coalescing around CPI? Is this the data point if they're still worried about inflation?
Actually, unless there's a big surprise with CPI, I would point to retail sales. And the reason being, we all know that we're making progress on inflation and it's incremental and it's really slow, and we are expecting PPI and CPI to show very slight declines. But retail sales feeds into the narrative of whether or not the economy is really slowing, follows on the jobs report. And so we'll want to see if there's an additional warning sign, an initial flashing red light about the economy. For that reason, also, the University of Michigan survey, while it's not directly related to spending, will also
election. We hear now the candidates starting to talk about the Fed almost on a weekly basis. J.D. Vance yesterday doubling down what Trump said in terms of, fundamentally this should be a political decision when it comes about interest rates. Are Fed members going to have to respond to this?
Well, they probably would once somebody is elected. They're not going to say anything beforehand. You may hear in speeches, as you have heard for the last number of years, that Fed officials think Fed independence is important, but they won't tie it to the political campaign itself. Now, if Trump were elected, and especially if both houses went Republican, then the Fed would have a problem, and they would start marshaling their lobbying efforts as they did when Dodd-Frank was written. But if you even get one house that's Democratic, it's probably not going to be enough for rewrite of the Federal Reserve Act.
Michael McKee, don't be a stranger. You're not. Thank you for being with us.
I'm not.
This week, you'll be joining us pretty much on a daily basis, and that is a good and beautiful thing. Coming up tomorrow, Mark McCormick of TD Bank, Matt Brill of Invesco, Keith Lerner of Truist, and Matt Lazzetti of Deutsche Bank. What do you think the conversations are like in the Fed committee when they get some of the criticism from politicians?
Well, Austin Goolsbee was asked about this last week on Fox Business, and he said cutting before all the politics surrounding it makes him a little uncomfortable. I imagine this is very uncomfortable. And they have to go out of their way to not look political, which in essence almost feels a little political.
Which is kind of the discussion that some people are having. We'll continue to have that conversation. I'm sure tonight there will be some commentary about the Fed as well in the conversation on X, also known as Twitter. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Futures higher after a tumultuous week. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Sonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
All right, looks like stocks kick off this week calmer as investors await key data which will shed light on the health of the U.S. economy and inflation and help us divine an outlook for the Fed. Meanwhile, Fed Governor Mickey Bowman warns inflation still faces upside risks, signaling that she may not be ready to support easing next month. And on the corporate front, Starboard reportedly takes a stake in Starbucks as Disney unveils expansion plans, including a new area devoted to the bad guys in movies. Let's take a look at where markets are trading right now. In terms of futures, we do see gains on the S&P and the NASDAQ, about 0.2%. We clawed back all of the ground that we lost on Monday last week and ended unchanged on the S&P. The 10-year yield right now at 3.95, inching ever closer to the 2-year, which, Nolly, I believe is about 4.06 right now. You have me on 2-year watch.
Last year was really the move higher, but yeah, let's see what this week brings, especially with that CPI print. Those individual movers we're keeping an eye on this morning. Matt, we're looking at NVIDIA really rising about 1.3%. It is moving the most by value this morning ahead of the open. Starbucks also rising on that report of a new activist investor taking a stake in the coffee chain. Starbucks up about 2.5% this morning. That is Starboard value ahead of Elliott now. Both big investors in that coffee chain. KeyCorp, keeping an eye on it, up more than 17%, absolutely surging here. Scotiabank agreed to take a 15% stake in KeyCorp. Matt, we'll keep an eye on the rest of the financials as well.
Yeah, absolutely watching. A lot going on in terms of the Wall Street beat, so you want to stay tuned for that. And then in terms of economics, we get some big inflation numbers out. Here with a preview of the week to come is Bloomberg's Michael McKee. And Mike, investors are more wary of each data point as we see how much volatility they can provide.
Yes, and I think this week is going to be a bit of a surprise, not in the numbers, because we're pretty good at forecasting CPI and PPI. I think we'll see continued declines. Those come tomorrow and Wednesday's CPI, and that's going to get a lot of attention because of the Fed. We are expecting slight declines there, though. So I'm looking at retail sales as the number of the week, at least for Wall Street, because it will fit into the narrative of the economy slowing down. Is it slowing down too much? That's going to be the question that people ask. Now, here's the CPI and PPI forecast. As you can see, very slight changes on a year-over-year basis, but continued further progress towards the Fed's goal of 2%, and just keeps us on track for perhaps a September rate cut. Not going to influence folks on the street as much. It's the retail sales forecast is going to be a little bit weird this time because we had the cyber hack for auto dealers in June, and that pushed down overall numbers. Now we're expecting a fairly decent rise in the headline numbers because car sales will be up. They'll have a rebound, but we're not sure about the rest of retail sales Even though we had Prime Day, et cetera, in July, there's questions about seasonals for the month. So will we see Wall Street think that we have a problem, or will we see Wall Street think we're on track for a move? And I was thinking, when you were talking about the Disney expanding, they could put in a Wall Street roller coaster ride.
Speaking of bad guys.
And make lots of big money on that.
I was thinking about your Deadpool reference over the weekend as well. The villains have a space in life. You know, how much room for volatility is there in the bond market this week? Because we have a lot of data, to your point. Just last week alone, we saw the 10-year move from under 3.8% to flirting with 4%, now a little bit under that. Still at least 100 basis points of rate cuts baked in this week. What are you expecting in terms of moves?
Yeah, I don't think we see a lot of moves, at least until the end of the week, if then we don't have auctions this week. So we do have the inflation numbers, but not moving all that much. So in theory, those will be priced. Then the question is, will people react to retail sales? And then on Friday, the consumer sentiment numbers, if those come in significantly up or significantly down, that could also force people to rethink what the Fed is going to do.
Mike, we thank you so much. We're looking forward to your coverage all week long. That is Bloomberg's Michael McKee. Let's get into market expectations for the week with BMO Wealth Management Chief Investment Officer Young-Yu Ma. You think about what Michael was saying about this week, the volatility you could expect is after the tremendous volatility we saw last week. What do you expect out of both the inflation numbers this week as well as the retail numbers?
Yeah, it has been quite a roller coaster ride, as was mentioned. We think the inflation numbers will probably come in favorably, but if there is a surprise, which we don't completely rule out, that could certainly move the markets one way or another. Hopefully that surprise would be on the favorable side. Retail sales, I think, are going to continue to show somewhat of a bifurcated consumer. On the middle and upper end of the consumer spectrum, I think that's still very healthy. On the lower middle part and lower part of the consumer socioeconomic spectrum, they still continue to face strains and challenges with spending and budgets and the effects of inflation. So I think how that plays out in retail sales overall could be a little bit on the soft side. I don't think that's deterministic for the economy, but it could give the Fed some additional ammunition or impetus for rate cuts in September.
In terms of those rate cuts, Young-Yu, I think you have an interesting take on the long and variable lags. Are they going to be shorter on the way down than they were on the way up?
I think the idea of long and variable lags is a rule of thumb, but of course, given the situation, the impact can be sooner or later, depending on what's happening in the economy. And I think the reason that we didn't see a very large impact from the rate hikes that took place, or it took a long time for that impact to set in, is the same reason that we'll see a quicker impact from rate cuts. I think there's a lot of pent-up demand by corporations that are looking to either roll over debt or borrow money or expand, that have been waiting for lower interest rates to do so. At the same time that we get rate cuts, or around the same time toward the end of the year, as this is rolling out and getting further rate cuts, we'll also see resolution about the election. And so I think this confluence of factors is going to come together with both lower interest rates, less uncertainty in the markets, less political uncertainty, and should have a greater effect on the economy. And that long and variable lag will probably be considerably shortened as we get rate cuts. And by the time we're just a few cuts or maybe 100 basis points or so into it, we'll start to see more of an effect.
Even if you believe you are going to get that first rate cut in September, that is more than a month away until we have that Fed meeting. And when you talk about the retail sales data, the bifurcation in the consumer, we've been talking about that bifurcation for a while. When does that bifurcation just bring more people into that pain spot here? How much pain between now to September to those long and variable lags do you expect to start rolling into the consumer that could then start rolling into the market?
Yeah, that's a good question. Is there a tipping point where we really start to drag down the economy? We don't think we're at risk of that, or at least not at serious risk of that. And Fed interest rate cuts would go a long way to reduce that risk even further. We think the underlying fundamentals remain healthy. We see that in the weekly initial unemployment claims. We see that in ISM services. We just don't see a lot of downward momentum in the economy. And it would be that momentum that would really start to have a binding effect and a greater downturn in terms of spending. So we feel pretty good about where the fundamentals are right now. And Could it take place? Yes, we could get that kind of downward spiral in the economy, but we think that would only take place if we didn't have rate cuts until well into next year. We think rate cuts in September, November, December would really go a long way toward shifting that dynamic and alleviating some of the pressures we see now.
We've heard lately a lot about a value play post election or post, vote in November. In fact, the last 11 elections, you've seen value stocks outperform growth for the first 6 months, post the vote. You like industrials. Do you think those two are kind of tied together here?
We think they could be tied together in terms of that value play, a bit of rotation from what has been a long run for large cap technology stocks or mega cap technology stocks into more value, even into small caps, but also industrials as well. Industrials on average tend to be more in the mid cap space. There's some large ones, some smaller ones, but we think that there is pent up demand. There are a lot of projects that will be, although they may have been pushed out a bit, they're still in the works, and there's a lot of spending that still is going to roll out in the industrial sector. And we think once the uncertainty of the election gets behind us, a lot of those trends that have become a bit cloudy will become a lot clearer, and those industrial names still stand to benefit from both spending trends, onshoring trends, and expansion and things like data centers. We think there's a lot of runway there to go.
What are the trends you're catching out of this earnings season, Young Yu? You think about the fact that we're almost there, but you also have some massive names. Walmart this week, you have NVIDIA at the end of the month. What are you still looking out for?
Yeah, it has been an interesting earnings season. One thing that has been noteworthy is that the beats by companies have not been quite as strong as in prior earnings seasons. And I think that's also given the market a bit of hesitation in terms of building momentum, or perhaps concern that there could be a flip in momentum to the downside. We're looking just for stability. We're looking for stability out of these big names. We're looking for signs of AI being rolled out further among companies and actually seeing those use cases turn into beginning or early signs of efficiency and productivity. We think that's very important because ultimately, whether companies such as NVIDIA can continue to do well will be dependent on the spending that takes place broadly across the economy for AI. And that's really ultimately going to be dependent on productivity gains, efficiency gains, really starting to kick in. And we think that that's a 2025 story, but it's nice to see early signs of that when they appear. So those are some of the things we're looking for in terms of anecdotal information at this point. We think would be hard data in the coming quarters.
BMO Wealth Management Chief Investment Officer Young Yu Ma, we thank you for joining us on this Monday, a calm Monday, finally. Another quick check here on futures. We're taking a look at those S&P futures, up still about 0.2%. Same goes for the NASDAQ 100.
So chill.
So chill out there. But the Russell 2000, pretty much flat, no bid in the small caps, really. Big change from what we saw just about a month ago. We're going to take a look at some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
And not so chill, take a look at the shares of B. Riley, absolutely plunging, down about 48%. The financial firm essentially pre-announced to the downside. They're now saying that they are projecting a loss. They've also suspended their dividend, and they are facing a U.S. probe over risk disclosures. Not everybody's surprised by this. There is a stunning 71% bearish short interest on this stock. Those bears really in action today. Let's take a look at another area that's under some pressure, and this, of course, is the crypto stock space. We do have Bitcoin and Ether up a little bit today, but Marathon Digital Holdings and Coinbase Global both lower. I believe that the source of this pain, probably the volatility in crypto, those crypto coins, but Marathon Digital also proposing a $250 million private placement. Some folks, probably investors, not pleased by the idea of that dilution. Let's end on a bright spot though, Matt, and this is Monday.com. These shares right now at pre-market session highs, up 10.3%. The discount retailer put up a nearly 67% earnings beat. They beat sales by about 3%. There is a 6% bearish short interest, so some of this could be a squeeze. But this retailer, it's one area, this continued mixed picture that we have for consumers, but discount retailer doing well.
All right, Abigail, thanks very much. Abigail Doolittle looking at some of the stocks moving for us on this Monday morning. Coming up, Starbucks is already contending with activist investor Elliott Management. Now another activist, Starboard Value, has reportedly taken its own stake in the coffee chain. Details next. This is Bloomberg.
think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs. Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Let's get now to high interest to look at what's making headlines around the world. RBC's former CFO said she had the chance to become the first woman to run the bank before she was fired over a personal relationship with a colleague or allegations thereof. That's according to a lawsuit she filed against the lender. Both she and the colleague were fired, and both have fired separate legal actions for wrongful dismissals, asking for tens of millions of dollars in pay and damages. The UK's Prime Minister is still locked in an ongoing disagreement with Tesla CEO and the billionaire owner of X, Elon Musk. Musk suggested the UK was punishing thought crimes by arresting people for online posts linked to riots in the country. The Prime Minister's office said it disagrees completely with Elon Musk. And foreign investors pulled a record amount of money from China last quarter, reflecting pessimism about the world's second largest economy. If the decline continues for the rest of the year, it would be the first annual net outflow since at least 1990. Shonali?
Now let's take a look at Starbucks pre-market. Shares are gaining on a report, let's say unconfirmed here, by the Wall Street Journal that activist investor Starboard Value has taken an undisclosed stake in the company. Shares are up about 2.3% pre-market. Starbucks has been struggling with the slowdown in demand, as well as pressure from, remember, another activist here, Elliott Management, which is one of course, the most feared activists out there. We're going to discuss it all with Bloomberg's Crystal C about what is going on at Starbucks. Of course, a battle with the company and activist investors. Its former CEO and founder here. How do you describe what exactly is going on and what it would mean to just add another activist on top of all this pressure?
I would describe this as a three-way battle anyway. So Howard Schwartz is very vocal about his vision for Starbucks, even though he no longer has a position, in a management position in Starbucks anymore. So he's been very vocal about it. He's very vocal about not settling with Elliott. And all in all, it just seems like if you're at a CEO seat at Starbucks right now, and let's not forget that he only took this seat 18 months ago, you're actually battling two fronts anyway. So whether it adds another activist into the mix, whether Starboard is in there, actually just like adds another complication, but it actually doesn't make it any like less or more complicated.
Schultz is the not only the former CEO, but I think the biggest individual shareholder as well. He's unhappy, and the reason these activist investors have a room to come in is Starbucks' performance has been bad, right? I mean, they're closing up stores, sales are down. What's the problem?
So the problem here is a lot of retailers, they're battling with labor issues. And not only is it that it's hard to find workers, there's also a unionizing effort within Starbucks workers. And obviously, they make coffee with humans still. So there are a lot of talks about whether... Still.
Not for long?
Not for long, maybe. You know, like there are a lot of talks about whether they could use robotics in some of this, some of their coffee making, and also whether they can, improve their app experience. Laxman, this current CEO, has been rolling out this online strategy, whereas actually Howard Schultz has been saying that we should probably stop doing mobile order so much. But it has been actually a big revenue driver. So that's like the conflicts within the boardroom, inside and out, is actually making this quite a complicated and interesting situation.
We should say CNBC also reporting now that Starbucks and Elliott are discussing a settlement. And according to the Journal report, Starbucks was not...
Of course they're discussing. I mean, they're in talks, right?
Well,
those talks continue today.
Crystal was making as well, you don't want, or at least Howard Schultz does not want, certain types of settlements here. What kind of progress, and we should also say here that according to the Journal report, they have not been made aware of an engagement by Starboard. So what is it that Elliott has been winning here, if they're winning at all?
So one of the biggest or most important tool that an activist has in their toolkit is replacing the CEO. So a biggest thing for us to watch here would be whether the current CEO, Lexman, having been in this job for 18 months, will be replaced at the pressure of Elliott. Also, whether Elliott's representative of Elliott portfolio managers would get on the board of Starbucks and give more control and pressure the company more directly would be another thing to watch. But the Starboard thing is interesting because it adds extra pressure to the company now, because you would probably want to settle more quickly with Elliott given that extra pressure.
The pressure is on. Bloomberg's Crystal C covers everything activism for us. Now, coming up, we're going to talk about Hawaiian Electric raising a going concern warning after the Maui wildfires ravaged Lahaina last year. We're going to have more on the potential price tag from one of the worst wildfires in U.S. history. Social Climbers is up next. This is Bloomberg.
Could face bigger challenges next.
It was going to keep winning World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's time now for Social Climbers, the companies making waves this morning. First up, we're talking about Hawaiian Electric, issuing a going concern warning and pegging liability from losses from the Maui wildfires at $1.7 billion. Last week, the utility company agreed to pay almost $2 billion as part of a settlement to resolve hundreds of lawsuits over wildfires that killed dozens of people and destroyed the historic town of Lahaina last year. Next, Rocket Lab USA says it successfully hot-fired its new rocket engine, Archimedes, for the first time. The aerospace company also posting record revenue and a narrowing of its second quarter loss. Finally, Intel is postponing an innovation event that was slated next month in San Jose, California. The chipmaker says it plans on focusing on webinars, hackathons, and the Intel AI Summit. The move follows a rocky earnings report last week when it reported a disappointing outlook and cut its dividend. And we'd like to make a correction on a story that we aired last week. We said 23andMe was exiting the DNA testing business and getting into the weight loss market. In fact, the company is planning to launch a telehealth membership program where users will be able to get GLP-1 medications. 23andMe will continue to offer DNA testing services, and we apologize for the error. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, I want to add, Shonali, another story that I imagine will be jumping up in the most read ranks right now. Moody's downgrading JetBlue's corporate family rating to a B3 from a B2. Now, this is key because Moody's is selling $2.75 billion in debt, or raising $2.75 billion in debt and loans backed by its loyalty program. Moody's says that it's going to take years for JetBlue's operating profit and cash flow to return to levels that would lead to materially stronger credit metrics, and that earnings continued to be pressured by at JetBlue by the operating environment, including increased competition in key markets along the U.S. East Coast, which obviously is very important to JetBlue, higher demand for premium products, and the inability to match cost inflation with revenue growth. So problems in terms of JetBlue's earnings potential, at least according to Moody's, and as a result, they're lowering the company's corporate family rating. We're seeing a lot of companies come out for debt.
We sure are.
Before all of this data comes out, before PPI and CPI this week.
Well, that's the time to do it. There have been a couple times in recent years where you had the banks actually miss those windows, and it really messed up as different types of capital markets issuances. I also want to point out, it's really interesting. You look at JetBlue, we do the functions on our terminal of DDIS Go.
Love it.
That's what you can see in terms of how much debt they have outstanding so far. That would be more than $2 billion already, with 11 total issues. And it's interesting to me that JetBlue is one of those companies that are backing their bonds by something somewhat esoteric, those loyalty programs this time around.
Yeah, very interesting. I love that function. DDIS Go shows you the debt distribution. Oh, there it is. And when those debts are coming due. Coming up, Northern Trust, and Weedy Behugana explains why she's comfortable being overweight equities after the volatility last week.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We descended into calm on Friday afternoon, and it persists today. You can see the S&P 500 and the NASDAQ both up about 0.2%. No major moves. And by the way, the VIX has fallen back to pre-non-farm payrolls numbers. So everybody's pretty chill. Down at the New York Stock Exchange, we can see TPL ringing the bell there. I'm going to get something to do with Texas. And here at the NASDAQ, you see IYF, I should say, transforming lives together. A quick check on how the averages are doing just seconds into the trade. We're looking at bigger jumps than were indicated by futures. The S&P 500 up about 0.25%, NASDAQ up about 0.2%. The small caps are running up the rear right now, only up about 0.1%. One stock to watch this morning is Starbucks. We've been talking about that this morning after a report that activist investor Starboard Value has taken a stake in the company. Now, we should say we haven't independently verified that. We don't know it to be true. The Wall Street Journal said, though, that Starboard has taken a stake in Starbucks after a couple of rough quarters. And we do know that Elliott is involved, and we also know that Howard Schultz has had a bad opinion of the way that company has been operated. Sonali?
I want to also take a look at KeyCorp here. Of course, after Bank of Nova Scotia took a minority stake in the U.S. bank, Scotiabank said it would buy about 15% of KeyCorp as it weighs a restructuring of its balance sheet. KeyCorp up about 16% this morning. We're also watching shares of JetBlue, the airline's long-term corporate family rating downgraded by Moody's to B3 from B2. You have, however, you do have a JetBlue moving after that bond issuance. We're going to take a look here with Bloomberg's Abigail Doolittle.
Yeah, it's absolutely plunging here, Sonali. Take a look at the shares of JetBlue, down 13.1% right now. Really down, given the fact that this stock has been down since its peak, down since 2004. We'll be taking a look at that in a moment. But relative to the debt deal sale, $2.75 billion, $1.5 billion in 7-year bonds, callable in 3 years, and then another $1.25 billion of 5-year term loan, and it will be used to raise reserves and fund general corporate purposes. Basically, they're looking to bulk up the coffers. Now, if we take a look at this stock and the airlines in particular against the S&P 500, we're going to see some massive, massive underperformance. We actually don't have JetBlue in here in particular, but since JetBlue's peak, down about 80%, so very similar here to, actually, that is JetBlue, so excuse me, but down about 80% from its peak. Back in 2004, it hasn't put a peak in basically 20 years, and you can can see the performance of the S&P 500 over the last 5 years or so. One thing that's really interesting about this, Matt, if we take a quick look at the company's debt load, I believe that this new debt offering is going to be added to this amount. The company's market cap right now, about $2 billion. So these airlines really strapped with debt. This is a big picture. Investors not liking the fact that there's going to be more debt added to this, and therefore that stock down more than 10%. Because, of course, stockholders come below the debt holders in the capital stack should things go awry.
Absolutely. All right. Thanks very much, Abigail. Abby, looking at the airlines there. Let's talk about stocks posting modest gains at the open, but at the end of last week, we clawed back almost all of the ground we had lost Monday. Still, Deutsche Bank says that investors are at the lowest allocation of stocks that they've been in some time relative to history, about the 31st percentile right now compared to the 95th percentile just about 3 weeks ago. Joining us to talk about this is Anwity Bahuguna, CIO of Global Asset Allocation at Northern Trust. Anwity, thanks so much for coming on the program. Do you think investors are going to stay this bearish on stocks? In terms of their allocations, it looks pretty weak, or will that bounce back just like we have seen with index prices?
Morning, Matt. Pleasure to be with you. I think it'll be the latter. We have seen stock market gains despite this general aura of bearishness that we hear from investors, and actually know that there are large holdings of cash on the sidelines. So it's quite possible for this rally to continue, in my opinion.
When you think about the cash on the sidelines, one question that I've been having is how sticky is that cash? Because even if you get that one rate cut, you have a lot of money in money market funds that doesn't tend to just flow out of those funds, does it?
It doesn't, but there is a tendency for the participants to chase performance, Sonali. So it is possible that when they see the persistence in performance, and we've had that now for about 9 months, and at the same time, the feeling is ratified through rate cuts, that rate cuts are coming. There'll be more than one, for sure. That sort of participation in stock market can give you so much better returns than what you get from cash once you factor in the future rate cuts.
In terms of the data that we're going to get tomorrow at 8:30 PPI, on Wednesday we get CPI, do you expect to see wild swings, the likes of which we've seen over the last few weeks when these little data points come in? And do you hedge against that?
Hey, Matt, yeah, that's an excellent point. Actually, when we look at the data right now, the options market saying that we could see plus minus 1% swings based on inflation data this week. But we don't actually make such short-term calls. Our time frame is typically 6 to 12 months. So this is really in the realm of things noise at this point.
Well, if you think about the noise that we have been seeing as well, some of this has actually nothing to do with the macro at all. Of course, we're watching a calm market headed into this week, but you still have the reverberations in the minds of investors from what we saw a week ago with the unwinding of the carry trade. To the extent that there's more positioning noise under the surface, how concerned are you?
Sonali, that's an excellent point. I think this started as a positioning event, and you saw that in the end, fundamentals dominated, right? So we had the positioning unwind of the carry trade. We had some sort of, I would say, broadening in U.S. equity markets also, where positioning has been so concentrated in the tech sector. And to me, all of that, Sonali, is great news. I'm looking for this broadening to happen, looking for positioning to flow towards other areas of the market where earnings are actually coming in quite strong. So there are obviously these periods of transition where folks move away from this narrative of inflation to now maybe broadening growth, and something to watch for, but these are opportunities to actually adjust your portfolios to where you want them to be.
Are you concerned at all about, earnings coming down? We're looking at, 11 or 12% for Q2. I think analysts are pretty bullish in terms of the full year, 9, 10, 11% for earnings growth. Does that still track?
Absolutely, Matt. In fact, when we started the quarter, I think expectations in the market were somewhere around 9%. And we are seeing, as you mentioned, closer to 11% in earnings this year, this quarter, I'm sorry. And our expectations for 12-month ahead is around 12% also. But as I said earlier, I think the most heartening thing for me is that earnings are broadening. They're not concentrated in one or two sectors. And that, I think, is great news.
And Wendy, thanks so much for joining us. And Wendy Bahugana there of Northern Trust talking to us about her expectations for stocks and the economy in a sense. I mean, it's interesting. We got almost a growth scare a couple of weeks ago with the non-farm payrolls number, and I realized there were positioning issues that helped to drive the market down on Monday, but we clawed back almost all of last week's gains after the unemployment claims number came out better than expected. And people seem pretty sanguine now about the economy in the face of, you know, only 25 basis point cuts expected from the Fed.
And we have a ton more earnings left. I mean, not a ton. We're mostly done, but some of the big ones. Walmart is coming up. NVIDIA is still coming up. What's interesting here from the earnings story so far, according to Bloomberg and Bloomberg Intelligence here, is that there is expected to be, outside of the Mag 7, the first profit growth for all of the S&P Mag 7 since the fourth quarter of 2022. There's another index I want to take a look at here quickly, Matt, and that is that KBW Bank Index, because you have almost every stock here in the green after that deal from Key Corp here from the Scotiabank. Yes, 15% higher for Key Corp, but Comerica, First Horizon, both up 4 or 5%, almost every stock in the green. On the flip side, want to take a look here at B. Riley Financial. The stock is had been halted. Yes, it now is trading once again. It had fallen as much as 50% or more, now down about 48%. It is facing a wider probe on its risk disclosures. Remember, this is a small stock in the scope of things here, but a boutique bank nonetheless. Tough moment for that stock.
Right, and together with it, right? So the write-downs have to do with a retail investment, and now the SEC is looking into the CEO's relationship with the head of that retail business. They have a close business relationship, and that's just not the kind of headline that you want to see if you're an investor. Coming up, villains taking center stage at Disney. We'll look at the company's new theme park strategy next. This is Bloomberg.
So a number of people, I think, from Homeland Security and NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear policymakers and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
This is Bloomberg Open Interest. A quick check on stocks this morning. It is a calm day in the market, but we are not holding on to the green territory that we had been in. S&P 500 flirting with red territory now, pretty much flat on the day, but all major indices here are now turning into the red mark. The Russell 2000, deeper declines here, about 0.1%, almost 0.2%, Matt.
Did you say indices?
Is it indexes?
You know, Bloomberg style, official style is indexes. The whole company has to get with it. All right, let's get to top calls right now. Some of the analysts' action and focus this morning. First up, Deutsche Bank says Eli Lilly is a buy. It's also raising its price target on the pharma giant to $300 or by $300, I should say. The firm says the company's big beat and raise in the last quarter settled some nerves in a volatile macro backdrop. You can see the shares not doing a lot this morning. They're leading a pack of companies out to raise some corporate debt before PPI tomorrow. Next up, Sandler recommending Robinhood as a buy and raising its price target on that stock as well. Robinhood reported earnings and sales that topped analysts' estimate for the quarter last week. The analyst cites near-term catalysts and longer-term growth opportunities for the optimism on Robinhood. And finally, Goldman Sachs initiating coverage of Kraft Heinz with a sell rating and a price target of $34. The company sees a choppy path ahead for the food and beverage giant as it attempts a strategic pivot, and as a result, Kraft Heinz shares are down almost 1.5%. Sonali?
There's another here at the Open. It's Disney. It turns out the happiest place on earth has a dark side. Disney is revealing a number of new theme park attractions, including the first devoted to movie villains. Joining us for more is the co-host of Bloomberg Technology, Ed Ludlow. And you think about just kind of the state that the theme parks have been in lately, the crunch on the consumer. How much can the villains draw people out to play?
Shout out whoever cut that villain montage. That's OG, some of those. I mean, this is fleshing out a plan that Disney gave us in September. $60 billion of capital investment over a decade. But the villain-specific theme park resonates with all of us. It must resonate with Matt Miller. It's going to be at Magic Kingdom in Florida. It's going to be equal in scale to that of the Star Wars theme land, which I've been to in Southern California. But again, for investors, it's kind of a patience thing, because construction on those projects won't start for another 5 years or so. And even though it's a big spend, they do take time to get people through the gate. And as you guys know right now, consumers have cut back, particularly on the low-income side, as reflected in Disney's theme parks mix. Last quarter.
You know, the kids today, Ed, would probably think of Hans of the Southern Isles, the bad guy in Frozen as a villain. But
or
the
like
greatest...
Tekka from Moana, something like that.
Exactly. The greatest villain of all time would have to be Darth Vader. Is he going to be at this park too?
Controversial of all time, because Darth Vader of Star Wars, now owned by Disney through acquisition of Lucas. But when I think Disney villain, I don't think about the Star Wars or Marvel universes. So that's an interesting spanner in the works. They're doing a lot of other stuff as well, right? Like they're going to have a Cars-themed park of significant scale and attraction in the same Magic Kingdom position in Florida. And I don't know if you guys saw, but they're also going pretty deep into the cruise industry with expansion of what was already ambitious plans for additional vessels, particularly, you know, maybe in markets like Southeast Asia, because there's demand there. But just remember that in the moment, we are worried about underperformance of this unit, because it underperformed at a time where streaming in particular did quite well last quarter. But parks and cruises and attractions has been the profit driver historically.
You know, it's interesting.
So,
those cruise ships in particular, I'm interested about, because I think about a conversation I had recently with the Royal Caribbean CEO, and he would say to me that he's competing with land attractions. Disney has some of the ultimate land attractions. Do investors have patience for not only their expansion, but also the cruise ships?
They're going to have to, because the cruise ships, when you build a vessel of that scale, you're talking about a very long timeline. 2027 to 2031 is when they kind of materialize in the oceans. But you raise a really interesting point. I hear it all the time on Bloomberg Technology. A competition for wallets and a competition for eyeballs is multi-medium. You know, you are trying to get consumers to spend money at a budget in a specific place. And, you know, one thing that Disney said, it kind of ties across theme parks and their cruise line ambitions, is that they're very good at being strategic, discounting for those demographics that are responsive to incentives and discounts. Specific markets, you know, vis-a-vis Western Europe or North America, etc. So it's a long payoff. But the stock's down like 0.6% right now. It's nothing for the here and now.
Ed, thanks very much. Bloomberg's Ed Ludlow there is the anchor of Bloomberg Tech. You can catch him at 11 a.m. in a show that you don't want to miss. Shonali, I'm always fascinated by these cruises. I've never been on one of the big boats.
Seriously?
To me, it seems like pretty bored. Have you been on one?
I have, but not since I was 18 years old. However, they're getting pretty souped up, I hear. I'm more interested in this villain park. I am more intimidated by going to Disneyland than most people. A lot of people scare me.
Oh, really?
In one place.
Oh, you don't like the crowds. I get it, yeah.
But I would go for Scar and Mufasa.
Yeah, I have great memories of going to Disney as a kid, and I can't wait to bring my kids there as well. But I think they would be too afraid of the villains. You've got to be a certain age.
From bad guys too, you know.
Yeah, you can learn learn a lot for sure from your fears.
So coming up next, we're going to turn to the Wall Street beat. We're going to look at more villains. We're going to look at the Wall Street villains. We're going to talk about creditor-on-creditor violence and its impact on funds. We're going to take a look at markets before we let you go. Of course, we're turning deeper into red territory on those indexes. S&P 500 down about 0.3%. NASDAQ 100 in conjunction. The Russell 2000 is where you're feeling a little more pain, almost 0.4%. We'll keep an eye on it. Stick with us.
Connection lost.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Time now for the Wall Street beat. This morning, we're taking a closer look at creditor-on-creditor violence. Lenders are scraping over how much money they can get back from ailing companies, and it's the focus of today's big take. Joining us now is one of the reporters on the story, of course, Bloomberg's Laura Benitez. And it's interesting because, let's say a year ago, we sat here with all these massive credit funds, and they all said, no way, the market is different now, we're all friends, we need to behave nicely with each other because otherwise, on the other side, people won't want to do business with you. Yet now you're standing here seeing some of the worst violence in credit markets that you've ever seen. What's going on?
That's right. And I think the difference, or one of the bigger differences from a year ago, is interest rates. Obviously, interest rates are higher now, and companies are really kind of finding it difficult to service their debts and to keep their balance sheets in good shape. So they're having to come up with lots of creative ways to keep the music going and to keep surviving for another few years. So we're seeing more and more kind of, innovative restructuring solutions being pitched. And this is where we're at with the peak in creditor violence.
This is the first year I've heard that creditor-on-creditor violence phrase. And
really?
But it's a dog-eat-dog world. I mean, were they much kinder and gentler to other creditors in the past, Laura?
I think this has been coming for a long time. It's been coming in stages. We first saw it with J. Crew, and then since then it's been happening more and more. And the reason it's been happening more and more is because there's been absolutely no protections, so no investor protections. I mean, there are some, but they're very, very loose, and that's been deteriorating for about a decade. So now we're at the point where companies are finding it harder to refinance. There are no protections in the bond doc, so lenders can do pretty much what they want, and companies can get creative and, cause some aggression, some mayhem.
Laura, if you are an American hanging out in your car, driving across the country, you might be listening to iHeartMedia, for example. You might not know that that's one of the companies engaged in this. Are they like a poster child here of some of what we're seeing? What's playing out under the surface that doesn't meet the eye?
I think that situation is just symbolic. So at the minute they're trying to restructure their debts, they're doing so with a select group of creditors. So that select group will be in conversations and they'll be trying to cut some sort of deal. For the other creditors that are not included in that group, it's quite nerve-wracking. You know, you're not included in those talks. Anything could be happening. They could be planning to prime you to be more senior. They could be pledging assets that you might have thought were yours elsewhere. So it's just kind of symbolic of just where the paranoia is in the market at the minute.
All right, Laura, thanks very much. Great story. Congratulations. Laura Benitez there talking about today's big take. Let's get you to the trading diary. This is what you need to be watching this week. We get the New York Fed's one-year inflation expectations in just about an hour and 5 minutes. Then tomorrow we get the PPI data, producers' prices. They come out at 8:30 a.m. Earnings from Home Depot coming out tomorrow as well. On Wednesday we get the consumer prices, the CPI data, and then we get earnings from Walmart and Deere. So some really big hitters out with earnings as the last 40 or 50 or so companies on the S&P still have to report. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at stocks that are down as the market turns around. Stay with us.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. We made it through the weekend, and we have a wonderful show lined up for you today. I'm Alex Steele. Paul Sweeney will be back within the hour. Coming up, we're going to talk about all the different areas of the market. If you take a look at commodities with oil getting a nice bid, Mike McGlone of Bloomberg Intelligence will be joining us. Plus, Scotiabank is buying almost 15% of Key Corp. We're going to break that down with Herman Chan, our regional banks expert over at Bloomberg Intelligence. Plus, Christina Hooper, Chief Global Market Strategist over at Invesco. She is one of the best. Let's get her take on what to expect over the next couple weeks in the market. But for now, let's get you up to date with Business Flash. So now John Tucker is John Tucker this week, because last week you were Michael Barr, but now you're you. So now you're doing Biz Flashes.
For the time being, but things can change.
But just so we're clear, we want to be clear with everybody.
Things move on a dime around here. This report being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. We've gone to green to red on the screen. S&P 500 now 14 points lower. That's down 0.3%, 53.29 on the index. Only 2 of the 11 major industry groups in the S&P 500 are higher right now. That includes information technology. That is in the lead. And, of course, that's home to shares of NVIDIA. They're going to report earnings later this month. Real estate and industrial is the biggest drags right now. Dow Jones Industrial Average down 209 points, and the NASDAQ 156 points lower. Even with the wild swings of last week, Kathy Jones at Charles Schwab says some degree of normalcy returned to the markets.
So everybody exited their existing trades, and the good news is that the bond market did pretty well. The Treasury market did quite well, and it is back to performing that role of safety and liquidity that people look for.
A Long Island City-based JetBlue ranking up more debt, selling $3 billion to be exact. Its shares right now are down close to 13%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex.
All right. Thank you so much, John Tucker. Appreciate that. I'm Alex Steele. Paul Sweeney will be along momentarily. But we want to dig deeper into the markets here. Abigail Doodle is Bloomberg's markets reporter joining us in the studio. Before we get to the individual names, Abigail, in your former career as a tactician, if you were to look at the S&P over the last 10 days, what would you tell me?
Well, what I love to do is live charting, because I have not looked at it in at least a few days, and let's see what we come up with here. The S&P 500 right now down about 0.2%, so it's really pretty ugly. What we're looking at is called a bear pennant as opposed to a V-bottom. This is a pause from all that selling action where both the bulls and the bears sort of regroup to figure out what's going on, who has the better information. A V-bottom would be different in the fact that we would springboard quickly higher to where we had been, so back above 5,500. This is basically just a pause where the bears are waiting for the next big piece of information that they can use, or even just a lull in trading, which we certainly have, to take advantage of the situation and start selling. So the target for the S&P 500 technically right here is, I'm just doing this very quickly, 5,500, 5,100, let's call it. So it's about 4,700 or so, so well below the 200-day moving average. It's interesting, Carly Garner of DeCarly Trading joined us last Thursday on the noon hour, and she's had a bearish call all week, and she's been patient, saying sometimes these things overshoot to the upside, and that could even happen now. But her target, actually, funny enough, happened to be 4,700. She also had a target of 4,100, and then she even had a target, possibly worst case scenario, of 3,500. So this is a long way of saying that the charts don't look so positive.
Wow, okay, that is definitely a way of saying that. See, I knew you could do live charting for me right now on
I love it.
Radio.
It's my favorite. Give me a name.
Yeah,
What are you
okay,
doing?
so let's get to some of the individual names. B.
Sure.
Riley is down by about 47%. What's going on here?
Yeah, this is pretty extraordinary. I mean, it's not every day that you see this. Now, one thing I would like to point out for this financial firm, there is a 71.1% short interest on this stock. So people were expecting bad news and they got it. Today, there was a bearish pre-announcement to the downside. There's a net loss. They also are suspending their dividend. There's a wider probe on risk disclosures. Basically, everything that you could have go wrong on a stock is going wrong here. So that's basically what's going on with B. Riley. On the other hand, if we take a look at Key Corp, last time I looked, those shares were soaring. Key right now up 12.8%. Scotiabank buying 15% roughly of Key Corp for about $2.8 billion. So that's probably a bit of a relief to some of those regional bank holders after everything that's going on. I'm going to pull up a chart quickly there to see if it has surpassed the lows of 2023. And it is kind of right. It's still trying to make it. It has not gotten back to pre-SVB. So this is probably a relief to a lot of those investors who, will take that cash infusion.
Also, Monday.com reported earnings. That stock is at a 52-week high, up by about 9%.
Yes, Monday.com, they put up a great quarter. They beat both top and bottom line. They beat earnings by about 67%, sales by, I believe it was 3%. So it's an interesting story here. We continue to have this bifurcation in terms of buying trends. And I think that I actually, it's funny, actually, I confused the story even right now with a company called Tuesday. Tuesday morning, that's what it was, Tuesday morning.
Monday,
the discount,
Tuesday.
Yeah. Monday.
What do they do?
So they're a cloud-based platform. Yes, Tuesday morning was the discount retailer that I was thinking about. That was sort of a high-end discount retailer. But they put up a good quarter, and the guide is good, and there is a short interest here too. So it seems like this is a bit of a relief to folks.
And before I let you go, crypto stocks on the move?
Yeah, and crypto itself is on the move. You know, Bitcoin had been higher by more than 1% an hour or two ago. Then it was lower not so long ago by 1%. Now it's down just slightly. Crypto stocks themselves are down. Marathon Digital talking about a potential $250 million private placement. That is not good news for some investors from the standpoint of potential dilution. So it seems to be dragging on that space right now. And also in terms of, technicals of, we start off with the S&P 500. If we just do a quick look here at Bitcoin, the last time I took a look here, it was signaling down toward 40K. Whew, yeah, I mean, these charts are just pretty ugly. So, there's a de-risking process that's happening right now in waves.
All right, Abigail, that's a great point. The waves, right? I've heard this is the second wave of a relief rally. How long does that last? That's a question that I have out there. Abigail Doolittle joining us from Bloomberg News. Thank you so very much. Let's get more on crypto. Also, just in the general commodity space, you got crude up by over 1%. Even though the OPEC report seemed modestly negative, but the geopolitical risks definitely up there. Copper also up by over 1%. So good for us. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist, is standing by in his hardship location of Miami. Mike, nice to see you. Let's just start with crude for a second. What do you think is leading the move higher? Is it going to be that OPEC report, even though it felt like that was more negative? Is it geopolitics? Is it just kind of an oversold bounce here?
I think you nailed all three of them. The key thing is for oversold is managed money net positions. Futures and Brent are the least long. They're actually short now in our database going back at least 10 years. So crude oil commodities are way sold out from a speculator standpoint. So they're indicating a bear market, but they've already priced for it. They already sold it down. And now I look at it, it's a little bit of change of pace for me. I still think WTI crude and Brent are not going to really bottom in this whole move until they get below their cost of production, which is below $55 a barrel in the U.S. and about $60 in Canada. But right now, they're being held up by those geopolitical tensions, and speculators have just sold out of their positions.
Right. So it's sort of like a combination of those positions and then sort of the headline of those risks. But as one analyst pointed out to me last week, trading geopolitics and crude is a tough business.
Yeah. Well, there's still that bet that it's I think it's keeping it somewhat artificially bid. If just look at the example, natural gas. Natural gas dropped to $1.60. The price it first traded in 1999. I think it's 1990. I think crude oil's going there. Just right now we have some other, obviously those other issues holding it up.
Okay, so before we get to Bitcoin, I want to talk soybeans, and I want to talk about corn, and you're going to love this. So soy is below $10 a bushel, corn below $4. This is the first time in years that we've seen this, and we get the WASDE report, which is the World Agricultural Supply and Demand report out today. What's going on here?
The revisions for production are going up. I mean, I was back out in the Corn Belt in July. Alex, I've just never seen it that lush. It's just shocking. So it was overdue for a drought. We need a drought to buoy prices. It's getting the opposite. So it's almost a perfect storm for lower prices. The only issue, it's great for consumers, great for farmers, some of them who've hedged, but it's really bad for prices. The key thing is you pointed out soybeans dropped below 10. The key thing I watch is corn. It's dropped below 4. Yep. 4 is a price that was first traded in 1974. So it's the #1 pivot. When it got to 8 and change, that was my first target to get there. We're there. It's not a place you want to really go lay into shorts, and that's what's happened. Managed money net position speculators have been record short this year. They've been making a lot of money, and that's why it's inching lower, but any little spark can spike them. You kind of got to flush them out to go down harder. So to me, it's mostly sold down, but it has good reasons as we go into harvest to be under pressure and not have much upside.
All right, because, we got a lot of stuff out there. All right, Mike, before I let you go, Bitcoin, you got Bitcoin up by a lot. Crypto stocks up a lot. What's going on here?
Leading indicators rolling over. Bitcoin put its peak in March, and now it's been almost a perfect storm for a peak. The cut in supply, the ETFs, and now it's the enduring hangover that's kicking in and leading lower. So I'll probably publish on it tomorrow. I've been pointing out this Bitcoin is below its 200-day moving average, as stock market volatility is just starting to recover from the lowest 200-day moving average in about 6 years. Bitcoin's a great leading indicator, 3 times the volatility of beta, and I think it's just telling us to be risk off. And gold is telling us to buy gold. Gold is outperforming the stock market on a 1 year, a year to date, 2 year, and 3 year basis.
Yeah, I mean, over $2,400 an ounce, man. Whew. I covered gold 17 years ago. This would be a level that would have shocked me back then. Hey, Mike, appreciate it. Mike McGlone joining us, Bloomberg Intelligence Senior Commodity Strategist. So the headline, in a good way, is Scotiabank buying about 14.9% of KeyCorp for about $2.8 billion. Now, remember, KeyCorp was one of the regional banks that was hit pretty hard in the tumult of 2023. So naturally, who do we go to? Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks. Usually we call on him when things are going poorly, but this feels to be a good thing for KeyCorp. Can you walk us through? Let's walk us through what KeyCorp actually was before Scotiabank decided to get in here.
Sure. So KeyCorp, regional bank based in Ohio, Cleveland, strong presence in commercial lending and has a really robust investment banking capital markets capability for its size. On the flip side, the bank has been really pressured by the higher interest rate environment. It got caught off sides a little bit by both its hedging strategy and its investments in low-yielding securities when interest rates were near zero. So its margin and profitability has lagged the peer group over the past couple years. That being said, things were improving and didn't require any additional capital infusion. There was on a path to self-help. Margin had already reached the bottom, but now with the $2.8 billion capital infusion from Scotiabank, they can accelerate that earnings profitability improvement story.
How long does it take to get something like this done? Like, has this been in the works for a while or what?
Yeah, it seems like based on both the calls that KeyCorp and Scotiabank conducted earlier this morning, the CEOs had ongoing conversations about a potential investment. From what I understand, Scotiabank wanted to expand in the U.S. And had done a lot of due diligence in looking at opportunities, and KeyCorp was their top choice. It adds a great earnings stream and exposure to the U.S. for Scotiabank, and for KeyCorp, it really improves its capital and liquidity and really puts them on offense rather than playing defense for the past couple years.
How are the banks like KeyCorp doing as interest rates may fall somewhat soon?
Yeah, I guess I would contrast that with the tumult of March and April of last year. The banks had largely been very defensive, pretty much up to the end of last year, reducing its lending capacity, trying to improve its capital and liquidity ahead of both fears about deposits leaving and also higher regulatory burden. Right now, it seems like they're in a much stronger position. Capital has been built up. They're back to lending. The only issue is there's not a lot of demand, and the banks are positioned for potentially lower interest rates that can improve some lending going forward. They've hedged a lot of the potential rate decline, so they're in a fairly good position to really prosecute the opportunity.
What about deposits? Has deposit flight stopped, particularly if rates wind up coming down? I'm just waiting for my markets account to all of a sudden start to tick lower on yield. Where are we here with that?
My high yield savings account is already ticked down in anticipation for rate cuts. So American Express, I'm not a big fan of that. I would say that deposits have really stabilized. There's no real rush to build deposits now because, as I said before, there's not a lot of demand for the lending side, so you don't need a lot of deposits to really fuel the muted demand appetite out there for loans. That being said, the deposit costs aren't rising either, and they're pretty stable because the Fed's stabilized the Fed funds rate for a bit now, and we'd expect some stable margin depending on the bank. Some could be up, some could be down over the next year, just based on their balance sheets.
Are there other potential targets for investments from other banks in this kind of scenario?
Yeah, from what I understand, there's a unique way of accounting for the Canadians, where a small portion of investments in financial institutions has a positive capital calculation. So it might be more focused on the Canadians in general. But that being said, we have seen some pickup in traditional M&A activity in the United States. Discover Capital One is the biggest one that we're still waiting for regulatory approval on, and then there's some smaller banks that have done some deals as well. So it seems like that the activity is going to rebound even more once we get rate cuts.
All right, really good stuff. Thank you so much, Herman Chan. He is so happy when he comes in and he doesn't have to talk about banks blowing up. So
exactly,
we appreciate
I'm no longer the Grim Reaper, so
no,
I'm happy about
you're
that.
not. It was like Sam Fazeli for a while with COVID, then it was Herman Chan with the bank blow up, and now we're in a different place. Herman Chan, Bloomberg Intelligence, senior analyst for U.S. regional banks. We very much appreciate that. I should point out that you're looking in Canadian dollars at Bank of Nova Scotia by about 3.6% on the day, as we wind up having a rally just, underway, say, in commodities, but in the equity market, it's a little bit mixed. The NASDAQ is up by about 0.4%. John Tucker, good weekend?
Yeah, those parts of it I can remember.
Oh, that bodes well. That bodes very well. Any movies that you saw or Olympics? Were you on the Olympic track this time?
No and no. Swimming in the Atlantic Ocean. A little chilly, but refreshing nonetheless.
I have to say, I definitely got sucked into that closing ceremony, despite all my efforts to not.
Oh, they're over?
They're over. Oh, my gosh, this guy. He missed it.
I'll have to wait for the Winter Olympics, or the LA Olympics.
All right. Well, he got 4 years. Coming up, Christina Hooper on her outlook for the markets.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker of the Bloomberg Newsroom. This Bloomberg Business Flash. S&P 500 hovering around 53.55 right now. The CBOE Volatility Index, the VIX, Wall Street's fear gauge, fairly stable around 20. This after an unprecedented spike that took the gauge above 65 last Monday. We have the S&P 500 12 points higher right now. That's up 0.2%, being led higher by information technology. The Dow 93 points lower. The NASDAQ 100 up 90 points right now. That is a rise of about 0.5%. So we get this week reports on inflation and retail sales. The government issues July producer price index tomorrow. The consumer price index, that's out Wednesday. The forecasts suggest inflation rates are moderating on a year-over-year basis, giving the Fed maybe some room to cut interest rates. And LL Flooring Holdings, formerly called Lumber Liquidators, has filed Chapter 11 to close several stores while attempting to sell its remaining locations. As we look at Treasury yields right now, the 2-year, 1 basis point lower, 4.04%. The 10-year, pretty much unchanged. That's at 3.93. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex.
All right. Thank you so much, John Tucker. I'm Alex Steele. Paul Sweeney will be back momentarily. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. We also take you outside the Bloomberg Intelligence universe to get the read on what people are doing with their money. And for that, we go to Christina Hooper, Chief Global Market Strategist at Invesco. She joins us now. Christina, you're one of the best about putting situations in the market into context and into perspective. So just let's start broad. How would you categorize the last couple weeks within the market?
So, Alex, I would characterize it this way. We have seen valuations get stretched. Let's face it. We've seen a very, very strong rally over multiple months without much of a pullback. So it makes sense that when stocks are closer to being priced for perfection, jitters enter the market environment, especially when we see some cracks appearing in the economy at the same time that the Fed is holding rates at very high levels, what I would argue is very restrictive given the level of disinflationary progress we've seen thus far. So I think of it as something of a small but almost perfect storm that caused a sell-off. Certainly that was the case in the United States, of course, greatly exacerbated and initially triggered by what happened in Japan with the carry trade. The Bank of Japan gave a somewhat surprising rate hike, and that triggered an unwind. And so we had several different events that came together to cause this sell-off. But just as quickly as that occurred, we saw a retracing of much of it because those proximate causes dissipated. And by that, I mean, we heard from the Bank of Japan that, in fact, they're going to be a lot more cautious with any more rate hikes if there is market turmoil or instability. And number two, we got a data point in labor, the initial jobless claims, that was better than expected, because in the U.S., the trigger, of course, for concerns about a heightened probability of recession came from the July jobs report and that increase in unemployment. So we've seen something of a recovery. I think we're going to continue to see investors walking on eggshells in the near term because there's still a lot of uncertainty out there. But I think it definitely was an oversold situation.
So then how does that set us up into CPI this week? Although I might say initial jobless claims before CPI, for example, more important, and then Jackson Hole. If positioning is kind of cleaned out a little bit, if we've kind of delevered enough, if technically we've already sort of stabilized, how does that set us up?
So I think we certainly will have jitters around not just initial jobless claims, but clearly CPI. But we have to take it with a grain of salt, right? Because we are seeing other signs of disinflation. In fact, I thought the most important data point from the July jobs report was wage growth, which has fallen to 3.6% year over year. But certainly we'll have markets hypersensitive to the data this week, especially CPI. And then, of course, we'll have a lot of sensitivity around Jackson Hole. Now, I look to history and say that typically that is used as an opportunity for central bankers to signal shifts in monetary policy. And I would expect that to happen at Jackson Hole. Not in every speech, but I think we should get some sense that the Fed will cut in September. Now, I don't think we're going to get an emergency cut before then. And I don't think we're going to cut bigger than 50 basis points because the Fed seems to be very confident in their approach. And keep in mind, they did a similar thing back in 2022. Many thought they were behind. I think they thought they might be behind, but they still only started with 25 basis points. And I think we'll see the same in September.
So to that point, how does the Fed signal cuts when the market's already pricing in 100 basis points of cuts? So it's like if they go too far, then all of a sudden we're going to be looking at, what, 50 again or being priced in?
Well, I think it's a reiteration that we're going to be gradual. That we are going to start cutting, but don't expect it to be at the level you think it is, because we're very comfortable with where the economy is right now, although monetary policy is too restrictive. So I think that's going to be the approach. So certainly not hawkish, but not the dovishness that markets are pricing in at this point.
Do you feel then, from that perspective, that the carry trade unwind blow up thing that we saw, is that over? Because the funny thing is, if the Fed cuts more than we think, that's actually worse for the carry trade blow up. Do we think that that part of the market turmoil is done?
I think it's largely done. Okay. I wouldn't say it's entirely, but I do take comfort in the reassurances from the Bank of Japan. And frankly, I don't think they need to hike again for some time. But yeah, certainly there could be wrenches thrown into it if the Fed, for example, is more dovish. I just don't see that on the very near term horizon.
All right, fair enough. What do you think we are going to see for CPI on Wednesday?
I think we'll probably see it somewhat in line with expectations, but I always take a step back and say, okay, let's say the month-over-month number is higher than we'd want to see. At the end of the day, the Fed is looking at a mosaic of data, and more important to the Fed, of course, is core PCE. And also, I think we often overlook that an important part of the Fed's calculus is consumer inflation expectations. We'll get the Michigan numbers on Friday, and I think that plays a role. Keep in mind that back in June of 2022, when the Fed decided to hike rates 75 basis points rather than 50, they gave as their argument in the press conference a couple of different data points that they had received, not just CPI, but inflation expectations. So I think that's an important part of the calculus.
It's such a good point. And it's also like the trend, you know, the directionality to be important there too. So when my husband texts me and says, oh my gosh, look at this market, what are we doing here? We have to do something. What do I tell him? Like, calm down, stay in your positions. Are we going to buy the dip here? Like, how do you deal with it as a market participant?
Well, I look at it this way. If we had been smart enough to turn off our Bloomberg terminals,
this is so true.
Do that, but turned on the TV and just watched the Olympics since the start, and then turned back everything on today, it wouldn't seem like anything dramatic, very dramatic, had happened while we were enjoying the Olympics, including the breakdancing section. And yet, that is not what we as humans tend to do. We fixate on every move and every data point. So I think to a certain extent, putting blinders on and thinking about the long-term trajectory of where inflation is going, where the Fed is going, can be helpful. I think we get so caught up in the short-term data and market moves when we often, as investors, we typically have much longer time horizons.
It's true. It's such a good point. I knew that double tasking here while on my terminal with my little TV up on the screen was the right call. Thank you for validating me, Christina. So does that mean that it's still going to be sort of growth, though, or quality? Maybe you go with quality. Quality over cyclicals or something? Is that a good way to also think about it?
Well, probably in the near term, it's going to be quality because there is a nervousness. There still is some risk-off sentiment, even though I think certainly conditions became oversold. Having said all that, if the Fed begins to cut and we start to see an improvement in economic data, then I think there's this assumption on the part of markets that there will be a reacceleration. That's my base case. And we'll see, in my opinion, markets anticipate that in advance, discount that in advance, which would mean small caps and cyclicals are likely to outperform.
All right, Christina, did you like breakdancing? Like, how do we feel about that in the Olympics? There's no one else who will talk about this with me in radio. How did you feel about it?
Well, I was very curious about it. I have to say that's something that I think of fondly as a child of the 80s. But I'm not sure I've seen breakdance moves like the ones I saw at the Olympics, so I didn't know if there were different rules in place.
This is fair enough. John Tucker has something he wants to say.
Is it a sport? No, it's not a whatever.
Do you think skateboarding is a sport?
Yes.
Okay, so what's the difference?
Because they're on a board.
Ah, okay. I don't know. I don't know about that. I loved it. I'm so sad it's over.
You're
All right,
turning
Christina,
me into a curmudgeon, by the way.
I'm not turning you into anything.
Yes, you are.
I'm just
It's
setting
your
you up
fault.
with certain questions. All right, Christina, thanks a lot. We appreciate it. Christina Hooper, Chief Global Market Strategist at Invesco. To be totally fair to John Tucker, I'm not entirely clear on the breakdancing thing either, but I support winners, and that's all fine. All right, coming up, we're going to talk to the reporter, Eliza Reynolds-Hannon. She's senior debt reporter. A big take story, which is super interesting and really complicated, so I cannot wait to talk to her about hedge funds as lenders turn on each other and how hedge funds play a role in this. We'll break that down after this. Let's go to Michael Barr, though, with world and national news. Michael?
Thank you very much, Paul, Alex, John. Ukraine's military has taken control of 28 towns and villages in Russia's Kursk border region, prompting a sixth of its population to flee. The acting regional governor told President Vladimir Putin more than 120,000 people have left their homes and about 60,000 more are waiting to be evacuated. Ukrainian forces have penetrated at least 7.5 miles into Russia. Former President Trump will be interviewed tonight by billionaire